Welcome to the Investor Expo show for January 16th. It's a new year. I hope everybody's having a good trading year so far, and January's been good to you. Today we've got a great show. We've got 5 amazing speakers. We're going to get right into it so we can move along quickly today. I know everybody's got lots of trading to do, so we'll try to get this as smoothly as possible. First on the show is drstoxx. He's also Thomas Carr. He serves over 15,000 clients around the world through his 3 sites. drstoxx publishes 10 daily, weekly, and monthly stock pick letters. He is the author of 3 trading books, including the international bestseller Trend Trading for a Living. His work has been featured in the Wall Street Journal, U.S. News and World Report, IBD, and various trading magazines. He has degrees from Oxford University in UK, and he lives with his wife and 3 children on the beaches of sunny Florida. Welcome to the show, Thomas.
Thank you, Jack. Great to be here again.
For sure. And so I know that previously I had heard something exciting that you had going on this year is that you recently, I know you've been teaching and educating forever and been a professor of the trading game forever, but you recently launched a live trading room. Is that right?
Yes, that's right. Over on stocktwits.com, I have a room called drstoxx Trading. It's a live trading room. So I'm in there throughout the trading day. We're calling live picks, day trades, short-term swing trades, mostly in stocks, but also some leveraged ETFs, occasionally some of the E-minis. And we're having a great time. We're off to a great start. We've got a good crew of experienced traders as well as newbies, and we've done very well.
Very cool. And now tell me, in addition to making the trade calls, especially when you talk about swing trades, which may be sort of few and far between, do you have conversation in the channel? Is there any training? What else is going on in there?
Yeah, I'm available for answering all questions that come forward, and we get to talk about strategy quite a bit. Usually, when I give a new pick, I'll explain why I'm putting on the trade, so that's an educational thing in itself. But there's plenty of opportunity to explain what's going on in the market and what I'm reading and what I'm seeing in the price charts and all that sort of stuff. So yeah, it's quite a it's a low cost per month way of getting a pretty good trading education, in my opinion.
For sure. Yeah, I know. I remember when StockTwix started, gosh, such a long time ago. It's great to see you joining forces and ended up having a room on there. So let's talk a little bit about, I know you're going to get into it probably in your presentation, but let's talk a little bit about, I just want to know your general philosophy. I know you're really big on trend trading. I know you're really big on following the rules. Am I right? Am I missing anything?
Yeah, no, that's it. I am a trend trader, so I do look for an established trend. It doesn't mean that we don't trade deep pullbacks or bounces off of support in deep cut low price movements, but for the most part, we're looking at stocks that have a higher than average relative strength. And we're also looking at companies that have strong fundamental growth. So I've dug down into fundamentals in the last 6-7 years, and my latest book details the research there. And so we look first at company fundamentals, and then we drill down into the charts and do some trend analysis, volume analysis. We pay attention to what's going on in the options on that stock. And then we look for little pullbacks or consolidations for our entry points. And we use trend lines to plot out the best map going forward, where to put the stop loss and where to take profits. But yeah, that's pretty much it. It's pretty strict rules-based trading as far as I'm concerned.
Got it. Right. I knew you were a stickler on the rules, which most successful traders are, but I know in your case, it's very important and you impress that upon your students. One last question, and then I'll let you get into your presentation. Going into this year, how important or how concerning is volatility for you in your trading strategies?
Well, it is important when it gets high. It's not a worry when it's low, and it's been low now for several weeks. The VIX index is down around 12, which is a very low volatility environment, which can also mean that there's a great deal of complacency. But complacency in the market can last for weeks and weeks, if not months. And that's mostly what I see going forward in 2020 here. I think we're going to have a pretty good first half of the year, heading into the general election, the latter half of the year, where we might see a bit more volatility come up. But I think it's going to be a pretty good trading environment over the next 4 to 6 months.
Got it. Very cool. All right. So let's go ahead and we'll turn the presentation over to you. You're going to have 30 minutes to do your presentation. And then after that, we'll jump on and we'll do 10 minutes where we can just chat. You and I can talk a little bit. I want to remind everybody that you can ask questions at any time that you want. And Thomas can either answer them during the presentation or at the end, I'll ask them in audio as well. I encourage you to ask questions. It helps the presentation. And if you have a question, I'm sure other people have the same question as well. So I just turn it over to you, Thomas. I'll wait till you get your screen up here.
Okay.
I see it. I got it.
So I'm okay. So you can see my screen now.
It's the correct one. Yeah. If you just start the slideshow, then it'll be full size.
Perfect. And are you seeing the full size, or are you seeing the?
I know I see the next slide with no notes as well.
Okay. Okay. Well, then we're on the wrong screen, but I'm not sure how to change that. But it'll be okay. We'll do just fine with this.
Okay. Sounds good. All right. I'll pick you back up. It's 8:08 now Pacific time. Pick you back up about 8:38. Okay.
Okay, Jack. Thank you.
Sounds good, Tom. Bye-bye.
Welcome everybody to our webinar. Today we're going to be talking about how to use screening tools to find the market's hottest stocks. And first wanted to start off a bit about my own trading story, because I'm not a professional trader by education. My education is in philosophy and theology, which is quite far removed from what we're doing here today. But I started back in 1996 with a small trading account and traded for about 6 years on my own, learning as much as I could. I studied under several of the big names in the business. And in 2002, I launched our first website, drstoxx.com, and it's been going strong every day since then. The first market letter that we started publishing from that site is the Trend Trade letter, and it's a very steady performing letter. 3,000% is up since then in 18 years of publishing that letter every market day. In 2007, we launched our second letter, the ETF Trend letter, which focuses on exchange traded funds. That's been a bit more successful in terms of performance, about 4,000% since then. In 2008, I was asked by McGraw-Hill to publish a book on my trading strategies. That was Trend Trading for a Living, and it's now in its second edition with a great deal of update to it. And it's Trend Trading for a Living that I was discussing earlier with Jack that includes my strategies for incorporating fundamental analysis as well as technical analysis into your trading. In 2010, McGraw-Hill came back again and asked for a book on short-term trading, and that's my micro trend trading book. In that same year, I launched our third letter. This is a weekly letter called the Momentum Letter. It's up 2,000% since that date. In 2014, I came out with a third book for McGraw-Hill, Market Neutral Trading, which talks about how you can put on long and short positions in competing stocks to give you a very good way of dealing with more volatile markets, making money both up and down. And then we came out with an options letter, which has been my the best-selling letter now, 3,000% since 2014, the date of launch. 2017, we launched a sister site, drstoxtrading.com, and from there we sell two weekly letters, the Hot Stocks letter, which focuses on fast-moving micro-cap and small-cap stocks, and our Penny Stocks letter, which focuses on stocks priced under $2 per share. Both of those, as you can see, are sporting very strong annual returns. And today, with all of our sites and our services, we're going strong now, our 18th year in the business. And Jack mentioned I have this new live trading room on stocktwits.com called drstoxx Trading Room. And you're welcome to join us there if you are interested in day trades, live trades. We always put on an exact entry price, a stop loss, and a target price, and those are updated throughout the trading day. Well, let's look at what we're going to be talking about today. Today, we're going to look at 4 keys to creating a bullish list of strong trading stocks. And I'm really going to do something that people in my business are really not supposed to do. And I'm going to give you some of the trade secrets today. I'm going to dig down into some of the key strategies that I use to find some of the best stocks for trading. And I shouldn't be telling you this information, but I just can't help myself because I love to teach. So we're going to start with that. And then we're going to look at two uh, very good trading tools that you can use to build screens that you will then use to find the best trading stocks. And we're going to look at the first of those in FinViz. I'm going to actually help you build a trading scan or trading screen that in FinViz, which is a free service. And you can use that starting this afternoon to find stocks that are worthy of trading today. And then we're going to drill down into a tool called MarketSmith, which is published by Investors Business Daily. Most of you are probably familiar with that publication. And we're going to do the same thing there. Now, I'm a partner with MarketSmith, and it's not a free service. It's a service that has a monthly charge. And if you're interested in taking a very low cost trial, you can email me and I'll get you hooked up with that. All right, so how to use screening tools to find the market's best stocks. Now we're going to start by looking at the 4 keys to creating a bullish watch list. The first key is sales growth. Now, a lot of attention gets paid to earnings when it comes to analyzing companies and their profit potential, which is what usually a stock price is based on. But earnings can be very deceptive for a lot of reasons that we won't go into here. And some of your best trades in the market are in companies that don't even have earnings. They're still not yet profitable. They will be in the future, they may be in the future, but they're not yet now. So there's no way of analyzing or valuing companies that don't have any net earnings. And there are ways of making earnings look a little more attractive than they actually are. For example, laying off a bunch of workers, right? Your costs go down and your earnings go up, but it's not necessarily representing growth in the company itself. Sales growth is something that you cannot fake. If a company is truly growing, its revenues are going to be growing, and that is organic growth. That's growth that is highly valued. So that's where we start. We start with companies that are showing strong sales growth. And then we do look at earnings per share, but we're not so much interested in a positive earnings per share. What we're looking at here is the estimates going forward that are being raised by either the company themselves or by analysts that cover the company. So in other words, a company might be losing 10 cents a share, but then it might come out somewhere between its earnings announcements. It might come out a couple of months into an earnings season, and it will say, well, look, we're actually doing much better than we thought. Instead of projecting 10 cents loss per share, we're only projecting an 8-cent loss per share. So that is a 20% rise in EPS earnings estimates. That's what we're looking for in companies that stand a very good chance of going higher over the near term. In fact, a fellow named Len Zacks, who created Zacks.com and Zacks Investment Research, well-known name in the business, he wrote his doctoral thesis at MIT on this very fundamental metric. He said that this fundamental metric, the EPS earnings estimate revision going up, is the strongest fundamental metric correlated to near-term price increase. So it's the most powerful fundamental metric we can have. We always want this to be a part of our scan if possible. Thirdly, we want to look for companies that have strong margins. This is something that I learned from Warren Buffett, who is one of the greatest all-time investors. And Warren Buffett was very strong and is still very strong on companies that have wide margins, because a wide margin means 2 things. It means strong pricing power. It means a company has a product that everybody wants and nobody wants their competitors. And so they're able to raise the price on the product and still maintain a strong salesmanship. And secondly, it means that the competition for that product, the competition for the line of services is very low. Those are 2 very good things going forward for a bullish price move. And then lastly, we want to see relative price strength. So we want to see a company that its stock price is already performing, because stocks that are already going up tend to continue to go up over the near term. You may know the name Eugene Fama. He is the founding father of efficient market theory. And that's the theory that says that the market has already priced in all the information it needs to give you the most exact price possible. And therefore, it is impossible to create any kind of an edge, any kind of a timing edge on the market. So the best thing you can do, and the only thing you should be doing, is investing in a big index fund. Okay, that's Eugene Fama, right? But he said he had to admit that the one thing he could not account for in his theory of efficient market theory is relative price strength. He said that was the one thing that seemed to contradict his theory. And it was the observation that stock prices that are going up tend to continue going up regardless of information that is already out there and priced in and discounted and so on. So that's the fourth thing that we're going to have into our scan in our screen. And so the next thing we want to do is get over to finviz.com and build a screening tool there. And you will note that Finviz has a little tab here called Screener, and you would click on that to get to their screening tool. Now, Finviz is free, but unfortunately, their free version contains a lot of ads. And these ads pop up, and you get little videos that pop up, and it's really quite annoying. But for about, I think it's $30 or $40 a month, you can get a membership to Finviz, and that will give you a little more range of tools that you can use, but it will also get rid of the ads. And once you click on that tab, then this is what you'll come to, a page with the screening tool itself. And that is where you will be building your scans. And you can see that I've highlighted the essential metrics that we will be building into our scan. And there's one that is not represented here, and that is the EPS price estimate. So I'll mention how we deal with that in just a moment. I always build my scans by starting off with a minimum price. I personally like to trade stocks priced $10 and higher, and the higher the better as far as I'm concerned. I know a lot of you like to trade lower price stocks, and we have, as I said before, we have two services that supply those sorts of picks. But for my everyday trading and for most of my newsletters, I look at stocks priced above $10 per share. And then I also like to have heavy volume on average. So I start with 1 million shares per day, which whittles down your list to just those very popular stocks. You might want to lower that if you're interested in lower price stocks or under the radar type of stocks. And then to cover our sales growth, we would come over here to sales growth quarter over quarter. You also have an option of doing sales growth over the past 5 years, but that's too long of a look back window. And we're only here looking for recent information because that's the most pertinent for near-term price growth, price strength. So we'll be looking at putting in a minimum figure for this, sales growth quarter over quarter. And we can't put in anything about earnings estimate revisions because that's not an option in Finviz, unfortunately. But if you take your list of stocks that you're interested in that have passed through all the other filters, you can take those stocks over to drstoxx.com, and for free, you can type in the symbol and it will give you the drstoxx rank. Now, a drstoxx rank of 1 or 2 means that earning estimate revisions are going up. A drstoxx rank of 1 is considered to be a strong buy. A drstoxx rank of 2 is considered to be a buy. So anything in the 1 or 2 range would be of interest to us. If it's a 3, 4, or 5, then the earnings estimate revisions are either non-existent or they're actually going down, and we don't want those. So that's how you can get around not having that particular metric in this filter. We're also going to use this net profit margin and the operating margin. We're looking at 2 different types of margins here. Net profit margin is for stocks that are actually making a profit, not all stocks make a profit. So in that case, you would be using operating margin as a way to capture a wider variety of stocks. And if you have too many in your list, you come over here and you put in something for the net profit margin to whittle down your list to only the healthiest of stocks fundamentally. And then the last thing we're going to put on is our RSI 14. We will put that at maybe something like above 50, which means that it is in the top half of all stocks for relative price strength. That's price strength relative to the S&P 500. So we want stocks that are outperforming the S&P 500, not underperforming it. And that's what that filter will do. So let's go to FinViz itself. And if I can bring this over to our screen. And you can see the ads are already popping up. I no longer have a FinViz account because I'm using MarketSmith for all my screening process. But let's go ahead and build a quick screen in here. Let's put in stocks priced over $10 per share, and average volume would be over 1 million shares, and sales growth quarter over quarter. We're going to mark that as high, which is over 25%. That means in the last quarter, there was growth relative to the previous quarter, the previous immediate quarter, of 25%. That's very strong sales growth in a short period of time. And those are the companies that are most likely to rise in the near term. Then we come over here to put in net profit margin. If we put it at high, which is over 20%, and that is very high for a net profit margin, that whittles our list down to 26 stocks. That's a reasonable amount, but let's see how many are still with us after we put in our RSI. So we're going to put in RSI at over 50, which is not oversold, and that whittles us down to just 24. Now, we can get that down a little bit further by playing with our RSI. Let's put that up to, let's put that up to 60. So we want 60 or above. That gets us down to just 8 stocks. And so these would be your 8 best stocks based on a net profit margin. If you wanted a few more of those, then you could delete the net profit margin, go to the operating margin, which doesn't necessarily mean the company is making actual net profits. We're going to put that at high, over 25%. That gives us one more stock. Okay, it didn't really affect our these ads are crazy, aren't they? Didn't really affect our list too much. But let's take a look at the list. You click on snapshot here, and you'll see that we've got nice technical charts. We've got a nice snapshot of the fundamentals of the company that we can take a look at. We want to see a lot of green over here and not too much red. That's just a very brief and quick way of eyeballing the charts for fundamental strength. And you can see that most of these charts, here's Facebook, most of these charts are already in fairly strong uptrends. Here's one that's been in a downtrend, but now you can see it's consolidating just under that trend line. That looks like a nice breakout candidate sooner or later. That's an energy company, and energy stocks in general have not been doing very well. Here's another energy company, a utility that is doing well, breaking out to new all-time highs. And there's a gold mining company. Here's a REIT, industrial REIT. So all kinds of different companies come up on this list, but these are all great companies in terms of sales growth, margins, and blanking on the last one here, and relative price strength. Now let's go back to our PowerPoint here and go over to look at MarketSmith. Now this is the tool that I currently use, and I like it so much that I asked the company if I could represent them in terms of my social media marketing and so on, and they agreed to that. And so most of the charts that I publish on StockTwits and Twitter and Facebook are MarketSmith stock charts. And the tool is just really amazing. It's one of these sort of all-in-one tools that will give you technical information, fundamental information, screening capacity, ranking. You get entry signals, you get stop loss levels, you get target prices with every stock that is triggering their buy signal. And of course, you get all of the great investors business daily metrics that are proprietary to them. So you get uh, their comprehensive valuation, you get their earnings rating, you get their SMR rating, which is one of my favorites. I'll explain that in just a minute. And all of that is located here in a one-stop shop for chart and stock analysis. The chart itself, as you can see, this is a nice chart of a semiconductor in-fee corporation. And the chart will draw in patterns like double bottoms. Here's a nice little cup and handle. It gives you the green dotted line, which is your trigger for entry. As long as the price is in this blue box here, you're in the buy range. This pink box down here is your stop loss area. The green box up here is your target price. And it gives you volume information. It gives you earnings estimate revisions. See these two little green triangles up here? This is exactly what you want to see in terms of earnings estimate revisions, because that means that the company both last year and this year have been and will be raising their earnings estimates. So they raised them last year 85%. They're raising them again for 2020, 32%. That is exactly what you want to see in a stock that is very, very healthy and growing and all kinds of good stuff. Okay, so let's skip over to MarketSmith and let's create a simple scan there for finding the market's best stocks for trading. And by the way, if you do want to take a cheap trial, you can just email me. Here it is, drstoxx at drstoxx.com. Let's go over to MarketSmith. And we'll open up the charting package here. And we'll get over to a daily look of the chart. This is a stock I happen to be in right now, which is INMD. It's a nice IPO with excellent fundamentals. And it came up on my scan a few days ago when it was down in this little dip area. We've been holding it ever since. Now, let's create a scan. So we'll go to new screen, new stock screen. Well, let's just give it a title. We'll just call it new screen. And you can see here that you have a variety of the Investors Business Daily proprietary metrics. You can also drill down and pull up things like, is it in the IBD top 50? Yes or no? Is it in the big cap 20? Yes or no? Was it featured in a New America article? If you're familiar with the newspaper, you'll know that column, yes or no. So those are all things that you can only do in this trading tool. But let's go ahead and work out a screen. So first of all, we're going to start with sales growth. And we want to do quarter on quarter because that gives us the most recent sales surge. So last reported quarter, we're going to put at a minimum of 20%. And I'm sorry, I also forgot that we always start with price and volume. So let's go there while this updates. So price, we'll put in a minimum of $10 per share, and we'll scroll down to volume. Let's put in a minimum of 1 million. It's a little slow here, but it does work. There we go. So 1,000 means 1 million shares. So we've got in our sales growth. Let's go to EPS estimates. So we go to earnings and we scroll down once it catches up with us here. We'll scroll down to estimates and we can put in, we're We're going to do a current year estimate of, we'll just start with 5%, which at least gives us a positive figure. You'll see a lot of companies have negative figures, so little red triangles instead of green triangles. And then we'll look at 1 year going forward, and we'll put it in 5 for that as well. So with those items in our scan, we're now down to 90 stocks. Let's look at margins. Margins, we want, let's see what we can do here with margins. You know what we're going to do? Instead of drilling down into individual margin metrics, we're going to use their SMR rating, which is my favorite rating of all of them. SMR stands for, S is for sales growth. We've already got that in, but we'll use the proprietary method of determining sales growth from IBD. The M stands for margin. So they're going to look at operating margin, gross margin, and net profit margins, and they'll rate those on a ranking scale. And then R is a metric of efficiency, the return on equity, which measures how well a company is using its cash and how well it's using its assets to bring in revenue. And so that together, those three, which IBD considers to be the three best things for determining financial health of a company, let's only look at stocks that are ranked either A or B. So we'll rule out all the stocks that have a weakness in one of those three areas. And then lastly, we're going to go to relative strength, and you can do this very easily by using the relative strength rating. And we'll put in, we're down to 66 stocks. Let's see, if we put in 90, let's see how many stocks that leaves us with. That gets us down to 23. So that's a pretty good start. And we've got everything in there that we need. And all we need to do is just start clicking on some charts. So here's DocuSign. DocuSign is interesting because it is in a nice, easy uptrend. We've got stochastics just dipping below 20, which is the oversold level. And everything else fundamentally looks pretty good, except it does have a fairly low EPS rating. That would be a bit of a concern for me. Let's go to the next one on the list. This is a financial property. Let's get something that's a little more exciting here. How about Fortinet, which is a company I've had for a long term. I bought shares 2 years ago in Fortinet. It's a internet security company, cybersecurity company. And it triggered a buy signal way back here in early November at a price of around $93 a share. And it's now trading at almost $118 per share a few weeks later. And it's already into this green profit taking zone. So at this point, you would be taking out your profits and moving on to the next trade. But that's a nice looking chart. What else? Well, here is the one I mentioned before that we bought a few days ago, and it's starting to bounce back. This is an IPO in the medical industry. I'm not exactly sure what they deal with. I know they deal with skin care or that sort of thing. Look at these metrics here, 99 EPS. The group that it's in, the medical group, is A+ rank. It's got an SMR of A. It can't get any higher than that. B- for accumulation distribution, which means that it's a little bit on the lower end because of this downdraft here. A lot of people are selling rather than buying, and that's causing the price to go down. You'll probably see that bump back up to an A- soon. The comp rating is 99. You can't get any higher than that. Timeliness rating, which is their sort of overall technical picture of the chart, is at a B, which is pretty good. Look at this growth rate, 328% year on year. And it's got some amazing EPS estimate revision numbers right here, 119% last year, 11% projected this year. Anytime you see two greens, you're in good shape. We'll look at one more here, KLAC, which is a big cap semiconductor company, well known, was a big trading stock for us many years ago. I got my trend trade letter subscribers into this, or at least tried to get into this. I'm not sure if we caught the entry today, but it was on this dip in stochastics down below 20, indicating that there was a healthy dip in an uptrend. It did tag the 50 period moving average, which is this orange line right here, after printing a nice rounded bottom with a nice little cup and handle pattern. It's now breaking up into the buy zone. So anything in this purple box here would be buyable. You would put your stop loss down here in this pink zone, and the green zone where you would take profits is off the charts. It's up there probably about 210 or so, 220. All right, so that's how you would build scans in. That's how you would build scans in both FinViz and MarketSmith. Obviously, MarketSmith has an easier way of putting everything into the same scan because you've got everything there in one stop. You don't have to take your stocks over to another site to analyze earnings estimate revisions. You've got a lot more interplay with the margins and the sales growth and so on. You can drill down into very particular things there. But the cost is that it does have a monthly fee, whereas FinViz, if you don't mind the ads, FinViz is a free tool. So there you've got two very good options for finding a short list of stocks that you know already are fundamentally sound. You know that they're growing. You know that they're projected to continue to grow in the coming year. And you know that they are in favor with the market because of the strong relative strength. The only thing you need to do from that point on is to look for a nice entry. Then you have to figure out where to put your stop loss and where to take your profits. That's one of the things that MarketSmith does help you with. But those are things that I teach as well in my webinars. So if you want some help on that, you can head on over to our site, drstoxx.com. Okay, Jack, that's all I've got. So I will open up the floor to your questions and then questions from the audience from here.
Hey, Thomas. So great presentation, as always. I mean, on here on the audience. So you know, when this last one's here saying different results with each scanning tool. I mean, can you elaborate on that a little bit?
Yes. Well, with FinViz, you will. I should start by saying they're both very robust tools. I've never had a problem using either tool in giving me stocks that did not pass the filters correctly. There are other tools that I've used in the past, and I won't name them because I don't want to get anybody in trouble, but there are other tools that are not quite as robust. In other words, they will pass through stocks that for whatever reason didn't quite match all the filter requirements that you had programmed into the scan. I don't know why that happens. I guess it's probably glitch or bugs in the software itself, but I've never had that problem with either FinViz or with MarketSmith. So they're both very robust. They will give you, however, different sets of stocks, different lists. That's primarily because the MarketSmith tool uses proprietary information that only is available through Investors Business Daily. So that SMR metric that I mentioned, the sales and margins and return on equity, together creates a kind of very unique filtering tool for weeding out stocks that have that very unique combination of fundamental strength. And you don't get that in FinViz. That's not an option in FinViz. So that's one way in which the two lists of stocks would be very different. They also are looking at different pools of stocks. So I know FinViz does not cover every stock that is available. It covers most of your big board stocks. It covers most of your main NASDAQ stocks, covers the S&P 500. It covers the Dow Jones. So a lot of your big key stocks are all there in FinViz, but it doesn't cover a lot of the sort of under the radar stocks or some of the smaller cap stocks or stocks that are not traded quite as frequently, the more illiquid stocks. So it has a smaller pool that it's drawing from, whereas MarketSmith draws from every single stock that's out there. There's not a stock that isn't a part of its universe. So that's another reason why you might get different sets of data coming through. As far as which one gives me the better picks, I don't think it's much of a choice. I've used both of them to supply trading ideas for my various letters, and they both have served me very well. So as far as the actual outcome of performance, I don't, at least I haven't tested it, so I'm just kind of going on memory here, but I don't think there's much of a difference there.
Okay, great. And so, in terms of getting more involved with you, you would say that the best next step would be to email you, or this MarketSmith investors link would be the best way, or to go to the stock twits and try to join the room, or what would be the best way for somebody that's watching this today and saying, I really want to get involved and I really want to learn more from
Mhm.
drstoxx? How would you like them to proceed?
Well, it depends on the kind of trader that you are and the sort of time that you have to devote to trading. If you're able to watch the market during the trading day, which means you either don't work or you're working at night or you've got a job that allows you some free time during the day, then you might be best served by joining our trading room over in StockTwits. That's drstoxx trading room. You'll find that in the list of premium rooms over at StockTwits. And that's the kind of trading where you need to have a bit of experience with trading. You need to be familiar with more short-term type trading. So most of our trades will last 3 to 5 days. Um, if that's not your style of trading, or if you aren't able to trade during the trading day, then you would be better served by going to our website, drstoxx.com, and watch the promo video at the top of that page, and you'll get a pretty good idea for the 3 newsletters that we have there and which would best suit your trading style. And if you're really new at trading, or if you have a very small account, you'd probably be best served by going over to our newest site, which is drstoxtrading.com, and take a look at the promo video there. We've got 2 weekly letters that have served our investors, our clients very well. And but they're more for small account traders or those that like to take on the riskiness of penny stocks. So that's what I would suggest.
Okay, so I went ahead and typed in the box here,
Uh,
the website www.drstoxx.com. It sounds like that's probably the best place for people to click to get started. Off, obviously, they can email you as well on here. But any other questions before we let Thomas go here? Um, Gary's saying thank you so much for the good show, Thomas. Great, and that's it. So let's go ahead and we'll bring on the next guest. I want to say thanks, Thomas, for being here. It's been a great presentation. As always, I want to recommend anybody that's interested in getting involved, click the link in the chat window for drstoxx.com or email Thomas at drstoxx@drstoxx.com. All right, so let's bring our next guest on the show. It is Lance Ippolito. He's a trader and educator at Alpha Shark Trading. He develops trading strategies using institutional order flow, volume confirmation and breakouts, and market internals. He's known as the market detective. He keeps track of large, fishy orders in the options market to pinpoint company insiders. He began his career as an analyst for various investment funds and for Citigroup Global Markets. As an educator, his goal is to foster a support system to help others achieve their trading goals. He received a finance degree from the University of South Florida, and his writing has appeared in many journals such as Futures Magazine, Inside Futures, Timing Research, and Professional Traders Options Newsletter. Welcome to the show, Lance Ippolito.
Hey, hey, how's everyone doing out there?
Lance, how are you? I got to say, so the last time you were on the show, I think in terms of enjoyment, you were a fan favorite. People just love hearing you talk.
Oh man, I when people ask what I do for a living, I don't say trader because for some reason they think like Trader Joe's or I trade stuff like I'm on Pickers or Pawn Stars. So
Right.
now I say I talk into a microphone all day and people watch me trade. And they go, "What? They watch you trade?" I'm like, Stock stuff."
So, so you're like a webcam guy, basically.
Yeah, the girls tend to get freaked out a little bit, and then I say, well, look at this body, honey.
So you're already entertaining. This is why I knew we got so many comments on the last show. So in addition to being highly entertaining and easy to listen to, you're actually really good at following paper and options trading, right?
I hope so. I mean, some days I am. Other days I feel like a complete donkey, and I feel like the worst trader in the world. But recently I felt like a genius, so hopefully we keep it up.
Hey, cool. That's good news. Good start to 2020. I know that I'm sure you're going to get into this, but what I really like about Alpha Shark, and as you know, I was a floor trader for many, many years. What I really like about Alpha Shark is how you guys are following the paper. You're not predicting the market. You're not guessing. You're not saying, "Hey, I know it's going to go up," or "I know we're going to crash in 2020," or anything. You're literally just following the paper. I mean, is that right?
You are about 99% correct. Every idea that Lance Ippolito has completely on his own, I know will not be a good idea because thousands of people have already had that idea. So if I strictly follow institutional order flow combined with my indicators, combined with my rules, my trading is, in my opinion, stress free, which to me is the one of the biggest factors of trading. And I tend to be right more often. So I take my opinions and my bias, everything Lance Ippolito thinks, and I toss it out the window and strictly follow flow that works to make money.
Perfect. I love that strategy because thinking usually gets in the way. And I would say historically, if you're not following the system and you're thinking and you believe that for some reason you're right, you're already wrong.
Indeed.
Well, cool. Let's get into your presentation. You'll have 30 minutes here. I'll make you an organizer now so you can see the questions. Again, I want to recommend everybody ask questions to Lance during the time so he can answer them. And we'll turn the screen over to you. You'll have about 30 minutes. Anna's going to take over hosting the show for the rest of the time here. So she'll be back on in 30 minutes to do a little Q&A with you and give you a chance to talk a little bit more about getting involved with Alpha Shark, which I know is a super cool organization and not only cool and profitable, but fun to be a part of. So I'll turn it over to you now, Lance, and we'll be back to get you in about 30 minutes.
Awesome. Thank you. I appreciate it. All right, hello everyone. How is the trading day? I will try to keep this presentation under 30 minutes. If you have questions, because I love interaction, I don't like to read off PowerPoints or, just go through very basic things and sit and listen like some boring college professor. If you do have questions, post in the chat. And if I don't get to it, post again. And if I don't get to it again, it's because I'm going to cover the subject in the next few minutes or so. But I do encourage you to participate, ask all the questions. If you want me to look up Tigger symbols at the end or when we get into the Q&A part, ask all you want. I'm here for you. And let's get started, shall we? So I am Lance Ippolito. You should see a picture of me with short hair and a beard, wearing a Nordstrom shirt and an Armani suit because I thought I was cool and hip back in the day when I was working for a fund. And little did that get me, but gray hair, wrinkles, and a gut to where I looked like I was 6 months pregnant. Risk disclaimer, I think we already went over this in the presentation, so I could skip it, thankfully. So a little bit of background about me, because you're probably thinking, who is this crazy wild man who trades all day and follows paper institutional order flow? So I actually had a real job at one point. I worked for Citigroup Global Markets, and then I worked for a hedge fund trading mostly the futures, and then we have long only equity portfolio hedging with the inverse ETFs, and it was great. I can't lie, I made good money, and I thought this corporate life is for me until I started to get stressed out, uh, had no time for my family. I could not take a vacation down to the Florida Keys, which is only about 4 hours away. I was working day after Thanksgiving, working holidays, and I realized a couple years into it, I basically had no life, no friends. Girlfriend left me, and my whole world was trading, and it wasn't a positive thing. So I left. I went to Costa Rica. 2-week vacation turned into 2 months, and now I basically look like a beach bum options trader. I don't know what that means, but I trade options, and I look like a beach bum with long hair who spends probably half his life on the water or traveling the world. So it's a good life now. So welcome. There's 3,000 actively stocks out there that pretty much trade options that you can pick out of. And one common question that I always get is, what stock should I actively be trading, and where you, the little guy, the little girl, where do you have an advantage, right? Because we have two eyes. I have my blue light blocking glasses because my eyes are bad. So really I have four eyes, you can say. And we can only look at so many charts during the day. I used to have 16 monitors. Now I have three. I want to, dumb down my trading. I want to keep it simple. I don't want to look at, thousands of stocks all day. So how can we simplify this? So we're going to go over topics to cover. When is the right time to buy stock? How long do we stay with a trending stock? This one is very important. When do we take profits? A very common question. How can we eliminate staring at charts all day? Ooh, sign me up for that. How can we trade stocks with an advantage? And real-time market makers, watch lists, and looking at the market makers' expected move. And then at the end of the presentation, how we can summarize, purchase, use the rate of change indicator for Thinkorswim. So, trading range. We've all heard of the term a trading range. When a stock moves out of its range, it breaks out, right? When we often think like, oh, wow, look, Tesla broke out. I'm going to go buy it. Or, wow, Lumpkin Coffee broke out. I'm going to go buy it now. That's usually the worst time, and we'll get into details into this, to buy a stock is actually on the breakout. Because once that happens, we're in chase mode. You might have heard that fear of missing out term being used on and on again. But when we're looking at a trading range, that's actually the time we want to get into a stock or build a position. So despite what you've been told, look, I get it. I read the books. I go to webinars. Heck, I was even at Schwab a few months ago listening to a webinar out there and thinking, wow, is everyone learning the wrong things in trading? Because despite what you've been told, you should not be buying a breakout. You should not be buying a breakout. Let me tell you why. When is the right time to buy? We want to buy during that trading range, that consolidation phase, when option prices. Now, if you don't trade options, you could use the same information for stocks. But when option prices are cheap and when nobody else wants to buy those options, okay? Because first of all, let's actually think of this from a supply and demand level. Why do option prices go up? I know, you're saying, oh, the stock goes up, the options go up. But options are priced from supply and demand. When everybody wants to go buy an option, those market makers will put those price of the options higher because there's demand. So you have volatility go up in the options, even if the stock doesn't even move, because there's demand. When somebody wants something, there's that demand for it. It's like this. You go to a baseball game and you want to get a Diet Coke. Now that Diet Coke's $10 because you're at a baseball game and you're thirsty, it's hot outside, you need something to drink. But if you were to go to the corner store before the baseball game, you could have got that Diet Coke for $1 because there's demand at the time for that Diet Coke. That's the same as options. When nobody wants to buy the options, when the stock is in a trading range, those options are dirt cheap. They're cheap. No one's buying them. That's the time to start building, to start buying those options and build a position. You see, most traders out there, and don't get me wrong, when I say most traders, I'm even talking to myself at times out there, because at the end of the day, I'm just a retail trader now. I don't have no fancy, I'm using Thinkorswim. I don't have any fancy setup that, some computer PhD person's using. No, I'm looking at what everyone else is doing. Because most traders out there, they see a stock rally. It could be a couple days, it could be a day, it could be intraday if you're day trading, and they'll buy the breakout. So they'll buy that breakout. But in reality, I should say, that's the time you actually want to take profits on the breakout. Basically, it's like this. When you see a stock breaking out and everyone's chasing it, you have that stock already. You have that option already. You're ahead of the curve. It's like you're the guy who bought the Coke, the Diet Coke for $1. Now you're at the baseball game and you're the guy working the stand. And now you're saying, hey, yeah, buddy, you could buy this for 10 bucks. You just paid $9. That quick. That's how trading should be on breakouts. You should be selling to the little guy. You should be selling to the guy out there who wants to, okay, he wants to pay you 10x. Sure. You'd be a fool not to sell that Diet Coke. So on this example here, this is Snapchat on the chart. Where should we take profits? On the breakout. Because what usually happens too on breakouts is stocks will go back into their trading range. When a stock does break out, they will tend to go back to their trading range. Or for example, here on Square. Square broke out after a nice rally higher. On the breakout, take profits. Very simple. We'll go into details of what everything means on these charts here. Give me about 5-10 minutes. So the first thing we want to look at what I did to help each trader out there is to keep it simple by identifying the trend with color changing candles. So when I see yellow candles, and this is customized whatever colors you like, I know that price is bullish. It's in a bullish trend. Price is above the ribbon. When I see cyan candles, it's bearish. Price is below the ribbon. I'm looking at a bearish trend on my stocks out there. And again, we'll go into details, but I just like something simple. I don't want to stare at, an RSI, a MACD, ATR 5.6 indicator all day. No, because you've probably wondering when I pull up a chart, like I'll pull up a chart right now of, let's pull up here, Home Depot. You see yellow candles, right? Yellow candles, bullish trend, and then we have a lower ribbon indicator. Price above the ribbon, bullish, right? Yellow candles, price above the ribbon, bullish. So you're probably thinking, well, Lance, is this some kind of, MACD or Bollinger Band, something like that? Because many of you have heard of a MACD, Bollinger Band out there, and you're trading. They're very popular. Again, very popular. Old school studies. They've been around for decades, and many traders have used them. But that last line, many traders have used them. They've been around for decades. I want to look at something with a modern day edge. That's it. I just want some kind of edge in trading. So when we look at Bollinger Bands, I'm not saying they're bad. I'm not saying that at all. A standard Bollinger Band, it's a technical analysis tool. It's defined by a set of lines plotted 2 standard deviations, positive and negative, away from a simple moving average, an SMA, of a stock price. Now, they could be adjusted. Again, they've been around decades. A Bollinger Band. We've all looked at them. We've all used them again. Then you have your MACD, standard MACD. MACD is a moving average indicator out there, divergence. It's a trend following strategy, and it's good. It's good. It's a good trend following strategy. You're on the right side of the trend. The MACD crosses over. Great. It was developed in the 70s. So we're looking at the 70s and 80s. So these indicators, MACD, Bollinger Band, they were good back in the day. They were. But the market has changed. Technology has changed. I mean, look at HFT firms and algorithms out there, and the modern trading has changed. So we need something that's up to date. That's all I'm saying. We need something that's up to date. Now, these Bollinger Bands out there, again, they're old school. MACD, they're old school. They're old school indicators that, quite frankly, today, you're reactive trading with them. So what I did was I updated a Bollinger Band with an option volatility cloud that works for trend following strategies when compressed the stock is in a tight range. Remember, I want to be a buyer of a stock when it's in its trading range. And when it expands, the stock is looking for a breakout. So we want to use this information to enter and exit trades at precision price points where the market makers are expecting a stock to go. That's really important because who controls the price of the options? It's not you, it's not me, it's the market makers. So if we're trading options, shouldn't we have some guide, some key to let us know where they're going to put those options, where they're going to price those options? Now for a MACD, we're using a derivative ribbon, a lower study, that locates a trend reversal with detecting buy and sell signals at a greater rate than your standard MACD. Because everything is trading. Everything in trading is rate of change. If we can use an indicator that is developed based on the rate of change of a stock, we have the advantage. Okay. So this is what I want to show you guys. This is, I had this chart up, but I just want to show how powerful it is. Okay. This is Tesla. Okay. Tesla stock. Now we see Tesla had a down move, right? We know Tesla had a down move. Remember back in the summer last year? Now I want you to look at this. Right here at 176, that was low, so about 185, we have our up arrow and we have our ribbon crossing over down below. So we have our yellow candles, and this is what's crazy. This is the first time we've had bullish yellow candles in Tesla and our ribbon crossover. This was June, early June of last year, okay? Now, obviously, I know Tesla's at 500 a share, and yes, it went from 185 to 200. That's after the fact. But what I want to show you is real time examples. Okay, like an Intel catching the low off a bearish move lower. Intel, we have our ribbon crossover. Okay, so we have 1 ribbon crossover, 2 our up buy signal, 3 our yellow bullish candles, and we have price in the option volatility cloud. So we have criteria that's being met time and time again. 3 easy steps. Ribbon crossover, bullish. Yellow candles, bullish trend. Buy signal, up arrow. Boom. We have all that. That's all we need in trading. We have 3 confirmations. Okay. Now, I know some of you day trade. So do I. Heck, I've been day trading all day today. And to be honest, I like day trading. Some days I'll just day trade. I won't even swing trade. I really do. So day trading. I know you've probably heard, or if you haven't, an ATR study, an average true range. It's commonly used for day trading stocks. Personally, I don't want to use something that everybody else is looking at, okay? I want something better. I want some kind of advantage. That's all I'm asking for, is a little advantage out there in trading, okay? So if something could give me that advantage when I'm trading, again, that's all I want. A little advantage that somebody else doesn't have, that some big computer science PhD algo place hasn't developed. They're not, they're not looking at the standard indicators that we are. I want something that the market makers, again, I'm trading options most of the time. I want something the market makers are using to calculate price movements, okay? So what we have is this when we're day trading. This is the ATR study. You'll never look at it again. We're going off, and this is a chart of the S&P futures. What the market makers are expecting, it could be the S&P futures. It could be any stock with options. Even if you don't even trade options, you're day trading. We're looking at what they are predicting for the market makers move that day and the price of the options. So again, ribbon crossover, check. Up buy signal, check. Yellow changing candles, check. Now what we have here is the market makers move, because remember, there's futures, there's options in the S&P futures. So what we have is this. We have our bottom range of the market makers move, which is right here. So our bottom range, It's this line right here. So we can look for bounces on that bottom range. Then we have our middle range. This is where the stock opens. So this solid line. And then we have our top end of a range to where the market makers need to keep a stock. So they're not going to let a stock go higher than the top end of the range. So you have to think, market makers, to be quite frankly, they screw us, the little guy. The market makers, their goal, because they're the ones selling you the options, is to keep a stock within their range. So they don't want to sell you an option for $1 and then have to buy it back at $10. No, they want to sell you an option for $1 and then buy it back at 30 cents. That's why we often hear buy it back at 0, have it expire worthless. That's why you often hear, 90% of options expire worthless, blah, blah, blah. Because the market makers are selling them. Or you'll often hear option sellers make all the money because they're playing within that market maker's move time and time again. So we can do that on any stock that has options, S&P future, even a crude oil future, gold future during the day. So when we combine the market maker's move with our color changing candles, our up and down arrows, and our lower ribbon indicator, it's a complete 3-step process for trading, from swing trading to, like these examples, even in day trading. Now, this is how we calculate it. And you don't have to be a math nerd out there. I hired a trader programmer who's absolutely fantastic. It's called the Geometric Brownian Motion Model, the GBM. It's used to model stock prices in the Black-Scholes model, and it's most widely used, or the Black-Scholes model, which is most widely used model of stock price behavior. So we're looking at calculating the market maker's move using the geometric Brownian motion model, and we're calculating the 1-day move. Okay. Now I know what you're probably thinking. Well, Lance, if a stock has, let's say Apple, and the weekly options, the implied move is $5, and there's 5 days till expiration, wouldn't it be implying a $1 move each day of the week because there's 5 days in the week and each dollar? You would think that would be the case, right? Right, and that would be a really good idea, but that's not the way it works, and that's not the way this math is created. Trust me, if it was, it'd be super easy. Probably everyone would develop something then. So here again, ticker symbol. This is Morgan S&P futures. What do we have? We have our yellow candles. I like these. It's so easy to follow the trend. The candles stay yellow, stay in the trade. Ribbon crossover, 2. And then we have, again, our buy signal, 3. And then we know exactly where to take profits. So again, market makers move, top end of the range, market makers move, bottom end of the range. If it goes to the bottom of the range, they're going to buy it up. They're going to send prices higher. If it goes to the top of the range, the market makers, they need prices to go lower. We can calculate our buy and sell levels exactly from the market maker's move. It's so easy to do. Again, a stock here, Mylon, opens up. You have your cyan candles, down arrow, ribbon lower, boom. Where does it bounce? Right at the market maker's bottom end of the move. Where do we get a buy signal? Bottom end of the move. Ribbon crossover. Easy steps to follow. Again, if you day trade, very simple step to follow. So again, confirmation. And I want to look at swing trading examples too if we still have some time left. Number 1, ribbon crossover, our trend direction. This is our MACD derivative. It is quicker than a MACD, going off the rate of change. Our color of our candles, confirmation to trend. Those yellow candles, bullish trend, easy to follow. Our trading range, this is for swing trading. And we'll pull up some charts here because we're looking at an option volatility cloud to give us a range of where the market makers are expecting price. And then B, our profit targets. Where are the market makers expecting the stock to go for a 1-day move? This is where we can sell, and this is where we can buy, just like in this example. Take profits on the top end of the range, buy at the bottom of the range. Some people think of it as a value area, some people say, but again, we're going straight from the market makers move in the options market. So watch lists. I used to have about 300 names on my watch list. Okay. It was just crazy. And I used to have 16 monitors, and I stare at charts all day. It was insane. So I still want to follow a lot of these stocks. I do. I like looking at everything. I pretty much trade everything. I like looking at so many stocks during the day. But physically, I cannot pull up charts all day long and stare at them. Like, I'm not going to have 16 monitors of charts. So Thinkorswim, they said it couldn't be done, but I and my team of programmers, we actually did make it done. We got real-time geometric Brownian motion model, aka the one-day market makers move, into a watch list. So instead of having to pull up each chart on each stock you're trading or each chart on each name you're looking at, what if you had the price targets, the top end of the range and the bottom end of the range, and the market makers move all on your watch list? So that's what we created. And again, this is almost every stock people like to follow: CMG, Home Depot, McDonald's, Wynn, UPS, Disney, Walmart, Lowe's, all these names, S&P futures, Starbucks, Splunk, Medtronic. I mean, names that I like looking at. First Solar. Ooh, all these names that I like looking at during the day. It actually has the market makers move, the dollar amount move, the top end, the price target to the upside that day, and the bottom end of the range of that day as well. So like CMG, stock is at 705.89. Market makers are implying a $12 move that day. Upside price 717.93. Downside price 693.85. So not only do I have that, and I have that visual I can look at, but I actually have these, if I pull up CMG chart, already located on my chart. This is game changing because this is real time during the trading day. Now, Toss said it couldn't be done. We could only get this information after the close, but this is real time, and it actually updates in real time during the day. It's just absolutely phenomenal. So trade with the advantage, and I don't want to run over on time. So when I'm trading, I know exactly what the market makers are pricing for stock and option during that day. So if I get a buy signal, I get yellow candles, I could buy stock, I could buy call options, and I know exactly where my price levels will be pinpointed on my charts and on my watch list. This is Qualcomm. Stock opens, up arrow, yellow candles, boom, pops about $2 right to the market makers move, take profits. So we've had fantastic traders, testimonials out there. Cynthia said down below on Facebook, bought Facebook 180.75 on Friday, was able to sell at 193.08 on Tuesday. I bought Square at 71, swing traded and sold for 74.10 in a week, huge profits. Day traded AMD with a buy signal, set it at the market makers move on a 5-minute chart, made $700 profit intraday. So we have here at Alpha Shark, you get the market makers move indicator for your charts, the watch list with the market makers move with your bullish and bearish price targets. You get the rate of change indicator with the color of the confirmation candles, those yellow bullish candles, and you get the up and down buy and sell signal alerts with 1 month of trade alerts. Usually get about 3 to 5 trade alerts a week. And all the updates, including our private mentoring sessions, are completely free. It's available for Thinkorswim at alphashark.com/rate of change. And normally on the website, we sell at $9.99. But for the webinar, we do have a special that it will take you to an only webinar price of $5.99. It goes through Infusionsoft, highly respected, one of the best softwares out there. And it is yours. All the updates are free. You can put it on your laptop. You can put it on your home computer, your work computer. You download it, and we have about a 60-minute video, how to use, installation guide, all the past mentoring sessions you get access to. It's a really fantastic, simple to use indicator. Only available alphashark.com/. Everyone can follow me, twitter.com, Lance Ippolito. You could private message me there. You can email me, lance@alphashark.com. I'm pretty much on Twitter all day. I have a private Twitter feed and post market updates on Twitter. So feel free to reach out to me there. But I want to show really quick too, how the rate of change indicator works in real time. Again, this is real time updates. This is my Thinkorswim account literally right now. Like here's in Home Depot. We'll zoom in here right at the open. Boom, buy alert, ribbon crossover, up arrow, yellow candles. Where do we get to? Look at this, within pennies of the market maker's move. And then what happens? The stock dips a little bit. So we're looking at literally precise to the T. I mean, again, look how powerful some of these are. Like Activision triggering a long signal right now. Why is this a solid signal? We have ribbon crossover right at support, buy signal, yellow candle, look for 60.79 as a price target. Guys, it's a really easy system to follow. That's why I like using it in trading, and that's why there's been such phenomenal feedback on it, especially in our mentoring sessions and especially with the trade alerts. Just we've had so many positive results. And I know some people used to look at 3 or 4 indicators and they're trading with tons of monitors. They said, Lance, I use 2 monitors now, just the rate of change indicator, and I'm good. My trading has never been this stress-free before, which that is my goal in trading, to eliminate stress and then obviously make a boatload of money. All right, everyone, I appreciate you being here. Thank you for your time.
All right. Well, welcome everybody. Thank you so much for being on the call. Happy trading, happy New Year's. If this is your first time being on the call with us, welcome, welcome, welcome. Let's see here. I just want to see something here. Okay, great. All right. By show of hands, just give me a Y, just to double check if you guys can hear me well, see my screen. I know Anna did, but I just want to make sure that people on the call can hear me as well. We can make this a little bit interactive if you want, but I'll just appreciate anybody. Just give me a double Y. Let me know that you can see my screen. That would be great. All right. Excellent. Great, great, great. Thank you, guys. Okay, so my name is Wally Olopade, and I am a technical analyst. I'm a market technician. One of my forte and my specialists is what I specialize in is in candlesticks. And I have been studying candlesticks for about 8 years now. And what I want to share with you today is something that might be brand new to some people, and for some people, maybe it's something you already know. But candlesticks is a very important part of my trading. I cannot trade without candlesticks. There are some people that say they don't need it. Totally get that. But I hope that today I can just share with you a little bit about the way I see candlesticks and why it is super important to me in trading. Now, there are over hundreds of candlesticks out there. So before you get overwhelmed, I'm only going to show you one today. And I'm going to show you this one because I believe this is more of the modern type of candlesticks that you will see in today's day in trading. I believe that over time, some of these candlesticks have become obsolete. And what's happened is that there are some that are more effective than others. And so rather than studying every single candlesticks out there, there are a few that you definitely want to pay attention to, and that's what we consider to be the modern candlesticks, because those are the ones that we see working day in, day out, every single day, every single week, every single month. Okay, so I'm going to do that today, show you one of those candlesticks and see how this can help you, hopefully, with your trading. But before I go into that, here is my risk disclaimer. Please understand that I am not a licensed financial advisor. Okay. The government actually tells us that we need to let people know that if we're not licensed to be a financial advisor, we need to let you know that. What I do is just sharing the things that I've learned from my style of trading, what has worked for me, what has not worked for me, the lessons I've learned along the way. And I'm just basically sharing that with other people with the hopes that, it can help them too as well. Okay. But that's about it. Before you place any trades, make sure that you understand what you're doing. You can lose money in trading. I have lost money in trading. I have blown 3 accounts in the past. So, trade is not something you just take lightly. You have to be aware of what you're doing. Make sense? Okay. So what are we going to be learning today? I'm going to share some simple tips on how you can improve your candlestick analysis. And then what I'll do is we'll go into a live charts. We'll go into the charts and actually see how we can apply this in the charts. Okay. So here is the candlestick signal that I'm going to be focusing on today. And by just a response, anybody, let me know. Does anybody know what this signal is? If you know the answer to this signal, please do me a favor, type it in. However, if you don't know what it is, just do me a favor, type in a N, and then that way, I know you don't. It's okay if you don't know what it is, but if you know the answer to this, just type in what the name of this signal is. Okay, all right. So some people saying bullish trend, other people are saying N, N, N. I see some N. Some people saying bullish engulfing. No, this is not a bullish engulfing. Okay, this is not a bullish engulfing, but good try, good try. All right, it is a bullish signal, true. Yes, it is a bullish signal, but what is the name specifically? Okay, now if you don't know the name or if you've never even seen this before, don't feel bad. A lot of people have not seen this, and it's when I actually first discovered it, to be honest, I didn't even know what it was either. But I noticed that lots of trend began with this same pattern over and over and over. And we call this the right side candle. Now, the reason why we called it the right side candle, which is the name of our company, Right Side Trading, is one, because when I could not figure out what the name was, my trading partner at the time just said, look, come up with a name for it. And that was the name that we came up for it. Okay. However, what you'll find is that we've been using this since then. I think we've discovered this in 2015, and we have used this to help us get into some really, really strong trends going forward. And that's what I'm going to be sharing with you guys today. So we call it the right side candle, and just a little bit about how to identify this right side candle. I'm going to give you some rules over here that will kind of help. And right now we can see number one is, look, it must be a red and a green candle. Okay, so it can be the same color. Now, if you're using a white and black candlestick chart or red and blue, just make sure that you have 2 opposing colors. You can't have 2 of the same color. So if you're using white and black, it has to be a black and a white. It can't be a black and black or red and red, white and white. Okay. But at the end of the day, you want to make sure that you have 2 opposing colors. You want to make sure that the bullish one, which in this case is the green candle means that you're making money. The red candle means that you're losing money for that day or that bar. You want to make sure that the green is on the right and the red is on the left. And that's what you see here. Okay. The next thing we want to know, which is very, very important, is that we want to make sure that the top of that green candle, okay, so when we're looking at the top of this green candle, this is very important. This top right here, the top of this green candle, must be above the top of the red. So this is where the top of the red is, that line. So I made that visual so that you can see that, hey, the top of this green is definitely above this horizontal line. The horizontal line representing the top of the red candle. So as long as you have the top of the green above that, that's fine. Then the next thing is that we also want to make sure that the bottom of the green, which is this down here, is also above the bottom of the red. So we can see this very clearly. And it's just as simple as that. Okay, we want to have, something above right here, and we want the bottom to also be above. So consider it like a AA if you want, and I like to look at this as, hey, this is an AA stock, right? Not Alcoholics Anonymous. I'm not making fun of anybody, but I'm just saying, when you think about ratings, this is a AA, okay? And so if you think about that, the top has to be above the previous candle's top, and the bottom has to be above the previous candle's bottom. All right. Okay. I got you, Charles. Charles is asking, what about the wicks? Very good. Very good, Charles. Here we go. Step number 5 or tip number 5 is what we want to do is we want to ignore all the wicks, all the tails, all the shadows. We want to completely ignore all that. So hopefully that answers your question, Charles. Makes sense. So we don't look at the wicks at all. So even when I'm still looking at this top, I'm not looking at the wick. We're just talking about the body. So the top of the body. and the bottom of the body. Same thing with the bottom, okay? And then now the thing is, the next thing I want you to do is once you have identified a right side candle, the only thing I would really like you to do is just draw a horizontal line at the top of that green candle. So in this case, what you would do is if you were to see this in any chart, okay, in any chart, what you do is just draw a line at the very top, a horizontal line at the very top of that green candle, not the wick, just the body, okay? And then the next question I usually get is people say, hey, what time frame can you use this on? Can you use this on a 5-minute chart, a 1-minute chart? You can use it on any time frame, any time frame. So please be aware of that. You can use this on any time frame. The other question I get is, does this work with commodities, futures market? Does this work with Forex? Does this work with cryptocurrency? And the answer is yes. As long as you're seeing a chart that have candles that has an open price, a closing price, a high price, and a low price, you can use it on any one of those. So please keep that in mind, okay? All right, so once we identify a right side candle, the only thing I want you to do is remember rule number 6 or tip number 6, which says draw a horizontal line. You don't buy, you don't do anything on that day. You just say, hey, I've identified one, so let me go ahead and draw a line at the top of that green candle, okay? That's what you want to do. Then what you want to do is number 7, which is wait to the next day. And what we're looking for the next day is that by the end of the next candle, if you were looking at a daily chart, you'll be looking at the end of the next day. Obviously, if you're looking at a weekly chart, you want to wait to the end of the next week. And if you're looking at a smaller time frame, you want to wait till that next candle shows up. At the end of that next candle, what we want is to see that it is closing above, the price is still above this horizontal line that we drew. Very, very important. Okay, so on the day of this signal, all you have is just an alert. It doesn't mean buy anything. It's just saying go ahead and get ready. Okay, go ahead and get ready. All right, so once you see that, say, hey, I need to be ready for the next day. Then you want to wait to see if price is above the next day's close, which is this horizontal line. Or let me rephrase that. Price is above the previous day's close, which is this horizontal line. The one last thing you want to do is this right here, where it says never buy if it is a red candle. So even if price closes above this line, the very next candle, make sure that it is not a red candle, or should I say a bearish candle, okay? Just make sure that it's not a bearish candle. As long as that's the case, then you can go ahead and start buying, all right? So let's do this. Let's go to the charts so we can actually see this in action and see how we can use this on the charts, okay? So for that, what I'm gonna do is take you back to the very first time that I became really profitable on this. So I discovered this in 2015. Actually, towards the end of 2014 was when I first discovered it, but then 2016. Now, I don't know, just give you some context. 2015 was when a lot of stuff was going on in China, and during that time, China was doing, kind of well, and then all of a sudden it stopped doing so well. There were talks about China coming up and saying that they were gonna, their currency was gonna overtake the United States dollar, and then it started going down. And if anybody recalls, in August of 2015, the market dropped really big. I think the Dow dropped 1,000 points for the first time in August of 2015. And then the market just kind of trickled on like that throughout the rest of the year. Well, by the time January 2016 came, we were dealing with this right here. This is what happened in January 2016. And truth be told, even I was looking at this and saying, wow, okay, we might be going into a bear market. I mean, everybody was talking about a bear market. And so, price came down, rallied back up. I said, okay, yeah, wow. It came up to this resistance level, and then now it's heading back down. I said, wow, it's going to go back down. This is the beginning of a bear market. We're going to go into 2016 as a bear market. People were coming out, the preachers of dooms out there were coming out. I mean, oh, this is the end of the world. This is the end of the stock market as we ever seen it. Financial crisis 2.0 is coming out. All kinds of stuff was happening. And everybody was talking about all that stuff. And it was very, very scary. Very, very scary. Until price came down to this level, which formed some type of a double bottom. And then guess what we saw right here? Okay, a right side candle. Now, if we go back, let me see if I can type up these rules that we had said. If you recall, number one, we said we want to have both a green and red candle. Okay, check. We have a green and red candle. Number two, we said the green must be on the right and red. Oops, let's try it again. And red on the left. Okay, we have that. Number three, what is it that we said about number three? We said top of green, above top of red. Okay, and yes, thank you very much for saying that, Jeff. Top of green's body. So, you know, we're looking at the body, we're not looking at the wick, right? Top of green body above the top of red body. Okay. What was number four? We said the bottom of the green body above bottom of red body. Okay, that was four. Number five, we said ignore all wicks. You remember that? Ignore all wicks. So Jeff, thank you for bringing that up. We ignore all wicks. Okay, number six, you recall, I said this is where once we've identified this, that's what we're seeing, we want to do one thing and one thing only, and that is to draw a horizontal line above the green candle. Okay, number seven, we said what? We said wait until close of next candle. And then number eight, which is very important, we said never buy on a red candle. Okay, so those are our rules. Sorry, it took a little bit of time, but those are our rules. We can see that right there. So we can say from number 1 to 5, we can double check that and say everything is fine. Now, number 6 says draw a horizontal line. So we come over here and we draw a horizontal line at the top of that green body. So we come over here, we put a horizontal line, and that's all we have to do on the day that we identify this. Number 7 says that we wait until the close of the next candle, all right? And then we wait to the close of the next candle. And then number 8 says you can only buy if it's not a red candle. And in this case, we do not have a red candle, we have a green candle. Right then and there, that is our buy signal. So a lot of people will ask me, hey, well, at what time do you start buying? Well, you wait towards the close. Well, what if it closes already there? Well, we have something that we call the closing session. Okay, if we're looking at this on a daily chart, we have something that we call a closing session. Closing session is the last 30 minutes of the day. So if at the last 30 minutes of the day, you can see that this is looking like, wow, a solid green candle that seems like it's going to close above that, yes, you can enter that. If you want to be safe or more conservative, I should say, and wait until the next day, no problem. You can wait until the next day too as well. But if I was monitoring this, and why would I know to be monitoring this? Because we already had the alert the day before. Okay, so we had the alert the day before saying, hey, wait a second, we now have a signal that's telling us get ready for the market to go up. We wait till the next day, the last 30 minutes, you say come back and take a look at the market. You see that it's a solid green candle like this. At that point in time, you're ready to buy. If I came here in the last 30 minutes of this day and it was a red candle, I'll probably say, okay, yeah, this is not going to work. But in this case, you come here the last 30 minutes, you see that the market is getting ready to do something. It's like, wow, this is a green candle. Seems like it's going to close as a green candle. You can start buying at that time. And that's exactly what we do. Next thing you know, this is what the market, I'm just going to fast forward, you know, till today. Let me see if I can move this aside. You would notice that from that point on, the market has never touched that bottom since then. And I remember in 2016 when I said, hey guys, market seems like it's putting out a bottom. And when people were like, I don't know, this bear market, look at what the market has done till today. Okay, it started with that modern candlestick signal that lets you know a strong rally is about to begin. This is super, super powerful, okay? So condition number four, let's go back to condition number 4 so that everybody can understand that. Condition number 4 says bottom of green body above bottom of red body. And the question is, can it be normally satisfied intraday? Yes, it can actually. Yes, it can. Because if you look at intraday, depending on the time frame that you're looking at, so if you're looking at a 5-minute chart, that's the same exact thing. It can absolutely be done. Okay, absolutely, it can be done. Okay, now it might not happen as frequent, but without a question, it can definitely be done. Okay, it depends on what type of stocks you trade in. It depends on how much volatility there is. Somebody's saying no sound. Am I the? Can everybody else hear me? Please give me a double Y if you can hear me. Just want to make sure. Somebody's saying no sound. Anybody? Maybe I am being cut off. Okay, so we have somebody. Okay, good. Thank you, guys. Thank you. So, music guy, you're the only one that is not having audio. So, hopefully, maybe log out and log back in. Maybe that will help. Thank you, guys. I appreciate it. Okay, that's fine. That's fine. That's fine. All right. So, but to answer your question, I'm hoping I pronounced your name correctly, Vidula. Yes, it can be done. All you got to do, it can happen absolutely. So a lot of it depends on the, how volatile the stock is, how many people are trading it. But yes, you can absolutely have it. Okay, we've done that many times. All right. So the question is, during the day, because the trades are continuous, how can a candle be open above? It happens. Trust me. Just go to a 5-minute chart. You can see it. Absolutely, it can happen, because it all depends on how the orders are placed. So if a price is at, say maybe $100, and then and that literally ended the 5-minute chart, and then maybe for the next 30 seconds on the 6-minute, nobody's placing a trade, and then the next order comes in. Instead of at $100, maybe it came in at $101, and that was the order that was filled, you would get a gap up. But believe me when I say it can be done. Okay, it can definitely be done. Trust me on that. All right, and honestly, even if you don't, like, just go to take a look at the chart. You can see that. If you go look at the chart, you'll be able to see it. Okay, and if you still don't, send me an email because I can prove it to you. All right. Okay, so here's another example of when we use it again. If you recall, also in 2016, market was doing well. You can see right here that we had a right side candle. Okay, so this was a right side candle. We bought this, but what was interesting about this was that during that time, this was right before they were going to vote. The UK was going to vote on the Brexit thing, right? And I remember that very well. But I said, well, you know what? We got a right side candle. I'm going to go ahead and buy it. If you look down here, we had a right side candle down here, which gave us this humongous rally right here. And so when this happened, I said, okay, wow, we have another right side candle. It's time to buy. Now, Brexit was going to come out the very next day. And the consensus was, if UK decided to get out of the Brexit, market was going to drop. And if they decide to stay, market was going to rally. Well, the next, that night, the vote was going on. I remember staying up that night. And all of a sudden, what I noticed was that, they said, hey, UK had voted to exit Brexit. And so market dropped. And so the very next day, this is what we saw in the market. Okay. This is what we saw in the market. And thank you. So Vidula said she just verified. I'm not sure if it's, I'm sorry if again, Vidula said they verified it. It works on the smaller time frame. Thank you so much for confirming it. I appreciate that very much. Okay. So the market dropped big and I'm losing money now. And I was like, what? And I knew it was a market reaction. I knew the market was reacting to it. So I was like, my goodness, what's going on here? And so I was losing a lot of money by this time. And I said, man, I need to see how I can get out of this trade. And then I said, well, let me hold on. Let's see what happens. The next day didn't get any better. Market dropped even more. And now I was like, oh, man, I should have just. So have anybody felt that? Where it's like, man, I wish I should take my money when I should have taken my money. Long story short, I'm sitting there and I'm like, man, this really, really hurts, right? And then I said, one more day, if I may, one more day, and the market goes down, I'm selling everything. I'll take whatever loss I have. And so the next day, we get this. Okay. Music Mania says, are we using this on tick charts? No. So you are the first person to actually ask this on a live call. But no, that's the one thing I have not tested this on, unfortunately. Is the one thing I have not tested this on is on a tick chart. So I apologize about that. I probably should just go back and just double check it and see. but the tick chart is the only thing I have not tested this on, so I don't know the answer to that. Okay. All right, so going back to this, so hold on a second. I think on October 4, 2019, another one of your candle setups caught the next leg of the current market rally. Yes, I'm gonna show you that. I'm gonna show you that. Member TLT, I'll show you that. But it's unbelievable, right? You are absolutely correct. But yeah, so anyways, don't let me get sidetracked. I can get sidetracked very easily. Stop that, guys. I'm just joking. But yeah, anyway, so this is me trading this, right? And so now I see this. And I was like, oh my gosh, we got a right side candle. So what do? We go through our, 5 rules. We go up to number 5. It says, make sure it's a green and red. Yes. Make sure the green is on the right, the red is on the left. Yes. Make sure that the top of the green is above the top of the red. Yes. Make sure the bottom of the green is above the bottom of the red. Yes. Make sure that, you ignore all the wicks. Yes. What do? Number 6 says, do one thing and one thing only. Don't get too fancy. Don't get greedy, because some people start getting greedy. Don't get greedy. Don't get too fancy. Just draw what? One line up there. And then you wait for the next candle. And the whole rule is that if we wait till the next candle and we have a green candle that closes above that horizontal line, you buy. If not, you step back. See, in trading, one of the things we try to help people see is like, look, there's no hoping, wishing, guessing of anything. It's just looking at the data, which are now facts, because when I see this, you cannot change that information. Once that is printed on the chart, it's there. It cannot be changed. So rather than having to guess and all that kind of stuff, so look, let's just look at the data and what is the chart communicating to us? And in this case, like, hey, on this day, the way we read this is saying, hey, warning, warning, alert, 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 get ready. Okay, so I used to have a joke. I say, hey, look, if you have to go, pawn some stuff off and sell some yard sales so you can get enough money, it's literally giving you one day to go do all that stuff so that way you can have money to get ready. If you need to transfer money over from a bank account to your trading account, whatever it is, it's like it's giving you time to do that. And then the next day, we still don't know what's going to happen the next day. So we're not predicting the future. All we're saying is we're reading and say, hey, we have an alert. So the next day comes and we have to see whether it's okay to buy or not. It could easily turn into a red candle, but this is what happened. This is where I say back up the truck, load up the truck, your trading account with as much money, and buy, 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 buy. Okay, buy, 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 buy. Now, you got to understand, this was in the midst of one of the most negative news. I mean, they had people who were short in the market saying that this is the market that was going to go down. And if you saw all the news that was coming out, they say, yeah, the market had a relief rally, is what they called it. And I said, no, 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 you are mistaken. This is not a relief rally. This is the market telling you it's getting ready to trend. It is the one signal that I know that tells you to trend, which is very interesting because every signal has something that is very unique about them. That's something that you don't hear too much about. But in my studies, I started realizing that every single candlestick has something unique about them. The one unique thing about the right side candle is letting you know, hey, a trend is about to start. Not only is a trend about to start, but a strong trend is about to start. Okay. And so what ends up happening is when everybody was saying this market was going to go down, this market was going to go down, this is what we saw happen. All that money that I lost in that 2 days, in 3 weeks, by 3 weeks later, I had already broken even and I was making money like I intended to make already. This is super, super powerful, simply by understanding how to read a new language called chart analysis, right? I'll show you one more example. If you guys recall something that was more recent, in 2018, we had one of the worst quarters we've seen in a long time. October, November, December 2018 was so bad. I was just talking to a guy not too long ago, this past Monday, at an event that I was attending, where he was like, man, 2008 was really horrible because all year long he was doing well, but by October, November, December, he lost everything and more that he made in 2018. And there was a lot of people that got burnt from October to December. And so in the midst of all this, here comes all those preachers of doom, the talking heads and all that stuff saying the market is going to crash, market's going to crash. It was nothing but negative news all over the place. Some people were not even sure what to do. One minute, some guy would come out and say, oh no, we're not in a recession. Another person said, hey, watch out. You better start selling everything. Go into gold, go buy cryptocurrencies, do everything else. And quite honestly, when this was happening, it was not looking good. It literally was not. The day before Christmas on the 24th wasn't looking good. We go to Christmas. Some people went to Christmas, weren't happy. We come out of Christmas on the 26th and we see this, ladies and gentlemen. This is what we see. Another right side candle. So again, you can go through all the rules. All we do on the day we have a right side candle is we draw a line at the top. But as bad as this was, when I saw this on the 26th, I was like, oh, no way. It's over. It's over. And so what are you talking about? It's over. It's like, the market is bottom. We ready to go higher. And it's like, how do you know that? It's like the chart is communicating it. I said, well, but wait. I need to wait till the next day just to confirm it. Okay. So then the next day comes and then this happens. And I was like, oh, yes. You know, I'm all excited and everything. So it's like, it's time to buy. It's time to buy. People are like, I don't know, you know, Wally, this time is a little bit different, you know, because there was a report I read and an article I saw out there that said that this time is going to be different. I was like, you don't understand. The market is communicating something. I was like, I don't know, man. I don't know. Well, guess what, ladies and gentlemen? That same bottom right there is literally what took us to the all-time highs. And it's so funny now because here we are at the end of 2018, 2019, beginning of 2020. And guess what they all say now? 2019 was one of the best years we've seen in a long time. Oh my goodness, this was one of the best decades of all time. But when I was showing people, it's like, wow, the market is bottom, is getting ready to go higher. And I don't know about this. Look, within that time frame, we came back, took out the December high, we took out the November high, we took out the October high by April in 3 months. Took all that out, and then we're now at all-time high territory. Some people literally sat on the sidelines and I don't know about this, man. I don't know about this. This is not the type of trades I want to trade. And what they end up doing is missing out on something very powerful. Ladies and gentlemen, we cannot allow ourselves to miss out on this simply because we don't know what the chart is communicating. Look, you don't need a financial degree to see this. Okay? You don't need to be an expert to see this. It's those very basic rules. I'm teaching my 5-year-old daughter and an 8-year-old son how to see this exact same thing. And the beauty about them, the only difference is they don't know nothing about the news. So they're not swayed by that. They just see the data and they just start doing what needs to be done. So Vedala says, does this work in short? Absolutely it does. But today we won't be talking about that. But to answer your question, yes, it does. It absolutely does. Let me fast forward a little bit. Everybody's heard about Tesla and how Tesla has been doing so great. You know, the thing that is kind of interesting is how everybody talks about Tesla now. Okay, everybody talks about Tesla now, but when Tesla was down here, ladies and gentlemen, when Tesla was down here, when they had the right side candle back here, when it was around $200, nobody was really talking about Tesla like they do now. Like almost every day, Tesla is on the news today. Almost every day. Okay, why? Because it's up here now. But when it first started right here, when Tesla was first saying, hey, we're ready to go higher, people weren't paying attention to it. Then they gave you another chance to do so right here. People weren't paying attention to that. And it's like, wow, Tesla has done phenomenally well. It's all over the news. Oh, Tesla's bigger than Ford and GM combined and all this stuff, which is when the story starts coming out. But interesting enough, the stories come out after the stuff. And this is one of the reasons why we call ourselves right side trading, because look, you know, now the story's coming out here. What's going to happen to Tesla? That's what you have to figure out. But you know what? If you had been paying attention to Tesla back here when they first showed you that information, it's like, oh my gosh, Tesla is getting ready to do something. All right. So here's an example right here. Here's right side candle. Okay. But if we drew our line, what happened the next day? We never got that confirmation. So no, you should have never been in, Jim. Jim is asking, what about this right side candle on the 9th on January? You would have never bought this, and that's why we wait. Okay, that's the reason. I mean, trust me, I've gone through that. I've been doing this since 2015. I've been trading the right side candle, but I've been studying markets for 8 years now. Right, so the rules that I came up with were because of the things that I learned along the way. And so your question is definitely valid, Jen. I'm saying your question is valid, but that's why we follow those rules. If you had went through those rules that we talked about, rule number 6 says draw your line. Rule number 7 says only trade when price is above that line. And rule number 8 says never even trade on a red candle. So obviously you would have never even got in. Okay. And that's one of the ways you can identify some of the fake ones from the real ones. Because that's one of the biggest mistakes I've seen people make. They just see a signal. Oh yeah, I seen that. I heard this somewhere. I watched a YouTube video on this and I see, let me go ahead and jump in. But it's like, no, there's got to be some parameters around it. And that's literally what we did based on my experience of over 5 to 7 years of trading to see, hey, this will keep me out of these trades. This will keep me in these trades. Okay. Let's fast forward a little bit. Anybody ever heard of a company called Beyond Meat? Beyond Meat. You guys recall when Beyond Meat was doing so well? It came out IPO, shot straight out of the gate. Everybody was, yeah, this is it. This is it. This is the new thing, right? Everybody was in Beyond Meat. And so, Vedula, when you're asking that question, here we go. This right here is the exact opposite. And see, and the thing about the right side candle, I'm going to just put RSC. The biggest thing about the right side candle is it lets you know a strong what? Do you guys recall what I said? A strong trend is about to happen. So in this case, because this was a bearish version, that tells me, oh my gosh, when everybody was finally trying to jump into Beyond Meat, I said, do not do so. It's like, oh my gosh, Wally, are you crazy? This stock went from $50 to about $240. I don't want to miss out from the 240 to 1,000. I'm jumping in. I say, are you crazy? Look at what it just printed. It's literally telling you, get out, take your money, get out, take your money. How many days do you have to wait? Remember, once you draw your line, the very next candle that closes above that, as soon as you close above that, yes. If you're asking, if it doesn't close above that, how many days do you wait? No more than 5 candles. Okay, Pa? No more than 5 candles. All right. So if you draw your line, now in this case, because it's the bearish version, right, you will want to see price close below that. So let's say that didn't happen. You wait up to 5 candles. After 5 candles it hasn't happened, then something is wrong with that setup. And so I just move on. But in this case, we're looking at this, the very next candle. Now, this is on a weekly chart. Okay. This is on a weekly chart. Once that happened, it was like, hey, get ready for a strong, keyword, strong trend. And phew, boom. Okay. What about this? Anybody recall cryptocurrencies? Right? 2017, what was happening in Bitcoin? Bitcoin was on fire. I mean, everybody wanted to trade Bitcoin. I remember people asking, hey, Wally, are you in Bitcoin? Are you in Bitcoin? I said, no. At the time, simply because I couldn't find a chart for Bitcoin. I said, show me a chart, because I would never trade unless I see the chart. Because the chart is what tells me where's the footprints of the institutions. What are they trying to do with this? Okay. And so I was waiting. And then finally I went to an event in Las Vegas, and they told me, this was in November 28th, 2017. They said, hey, take a look at this chart. GBTC is a way to see what Bitcoin is on. It's an ETF of Bitcoin. I said, okay, fine. So I came there, I saw that. I said, oh, wow, that's pretty cool. So I started monitoring it. And then next thing I know, in January, February, this happened right here. You guys see that? Okay. As soon as I saw that, I was like, uh-oh, guys, take your money. Whatever Bitcoin you have, go sell. Oh, no, Wally, you know what? I like you, Wally, but this time it's going to be different, because you know what? It doesn't work so well on cryptocurrency. I said, look, candlestick is candlesticks. If it has an open, high, low, and close, it's the same thing. I say, I will not risk getting into Bitcoin right now. Oh, no. If it goes down, I'll buy more. Okay. I saw people who was, mortgaging, the equity on their home to go buy Bitcoin. I was like, this is not the time to do so. I was like, well, we'll just have to wait and see, because I read this article here saying that Bitcoin is going to be the new thing in the way that we transact and all that kind of stuff. Okay. Am I shocked that this strong trend took place? Not to me. Not to me. Okay. And this is what we have to learn to see. And this is just one candlestick, guys. Let me wrap it up with 2 more. Oil. We all heard about what's been happening recently. This is back to the daily chart. We all heard what's been happening recently with the trade war and all that kind of stuff. They're going to sign the deal. And especially when the whole Iran thing happened. Okay. Most people are like, oh man, the Iran thing is happening. Are we going to go to war and all that kind of stuff? But what ended up happening here? Oil back in December showed us a right side candle, which is what started that rally right here. Most people, the trade, the war things didn't happen until somewhere around here, when Iraq or Iran decided to send out those missiles. That didn't happen until somewhere around here. But the big move had already taken place way before that. And then last is, everybody started jumping into gold as well. So if you're talking about, hey, can we do this on commodities too as well? Well, same thing. As small as this is, but that was the clue right there in December. I had an email that I sent out to my subscribers on the 23rd of December. I said, hey guys, it was actually the 24th of December. I said, it's time to buy gold. It's time to buy gold. Long road, this is what happened. So being able to see these information and knowing what it can do for you, what it's communicating to you, is not only important, but it opens up your eyes to like things that you probably haven't seen. And again, guys, I'm only sharing one of these modern candlesticks out there. So here's what I'm going to do just to move on, because I got to start wrapping things up. Here's what one student said. I purchased a few of your videos from your website, and the information has totally changed my trading life and mindset. Great videos, Wally. Thank you very much. And that's what we strive to do, is like see things that nobody has been able to show you before, or at least a viewpoint from looking at this in a very simplistic kind of way is what we do. So how can you get started with the right side trading? I'm going to give you guys an offer. Let me talk about the offer that I have for you guys. This coming Tuesday, next week Tuesday, or this coming Tuesday coming up, I'm actually going to be doing a workshop on this whole modern candlesticks. Okay, again, today I only showed you one. If you like this, I have more that I can show you guys. Okay, so once you come to this workshop, you can go to the link at the bottom right there. Go ahead and sign up right now. I'll invite you guys to come join me on Tuesday night. On that Tuesday night, I'll be going over all this stuff. And here's what you'll be able to do once you understand all this stuff. Learning how to identify the right setups, okay, for the candlesticks. I showed you a snapshot of how to tell, one way of telling the difference between fake signals from the real ones. So if you ever been the type of person that say, hey, okay, I understand candlesticks all the time, but some of them don't really work. Well, it's because you don't understand how to identify the fake ones from the real ones. So I'll show you how to do that. When is the best time to use candlestick signals? Because you can't use them all the time. These are little nuggets that I learned along the way of my 7 to 8 years of trading, that I learned how to use candlesticks the right way. When to trade with stops, when not to trade, how to plan your trading better. Simplest way to tell when something is wrong, so that even if I get into the trade and something begins to happen, how can you tell? So you talk about when to get out and all that kind of stuff. Notice I didn't talk about that. When do you get out? How do you set your target? All that kind of stuff based on the candlestick. I'm telling you, all this is data. That's all it is data. But they tell you certain information that most people are not privy to. And the only way I was even able to do that was my years of studying candlesticks that works in this day and age. Okay, you'll be able to get rid of guessing when to buy, the fear of missing out, trading things in hindsight. That's one of my biggest pet peeves. People go, oh, did you see how this stock did? It's like, look, show me the ones that are getting ready to do something now. And even on that call, I'll be showing you things like, hey, look at these stocks right now that are getting ready to set up. Volatility, I don't worry about that anymore. Or fear of a bear market, you don't have to worry about it, because again, you'll see the warning signs right before it happens. If you don't believe me, you got to come see this. Okay, worries about recession, these are things that I used to be afraid of. These are things I heard people being afraid of, but you don't have to worry about that anymore. This is what one student says. Look, I just finished up watching your videos and lessons from Monday. I have to say, out of all the classes and all the webinars I've ever attended over the many years of trading, how many years? Many years of trading, I have never really understood or grasped the concept of when I should exit a trade until now. Your lessons have changed the way I trade. That was an email I got from somebody. It's like, wow, it is so simple when to get out. I see people get into a trade, they get out too quickly, and it's, oh man, I left money on the table. And even if they took a small profit, the fact that they seen the stock run so much, it's like they feel like they lost. Well, once you understand how to see when the chart is communicating, get in, get out, hey, there's a problem here, start adjusting your stops and all that kind of stuff, it's like mind blowing. And that's why people are saying, look, it totally changed. It changes the way they've seen things like they've ever done before. And so what if you're the type of person who already knows about candlesticks? Well, that's fine. Some of you might be saying, hey, there's too many of them to follow. I get you. But at the end of the day, what I'm going to do is I'm going to show you guys how to see just 6. I only use 6. So in the 8 years that I've been trading and all my studies that I've done over this, and I've done tremendous amount of studies, and this is why I call it a modern. I say, wow, out of the hundreds of candlesticks out there, these are the 6 most effective ones. So much so that it's like, look, I don't even trade anything else. I don't analyze any chart or any stock without using these 6. If it's not one of these 6, I'm not even interested. Okay. And once you learn these six, it's only six. I tell my kids, I said, look, you guys already learned your ABCs. There's 26 alphabets in the ABCs. I'm talking about six only. These six right here will literally change the way you start seeing chart. I don't need any report, any article. I don't need to hear anybody from the media. I can simply look at a chart and say, yep, this is a chart that is getting ready to go, or no, this is not a chart we want to go. Or hey, this is a chart that say, hey, get ready, or this is a chart that's saying, take your profits. All right. I can analyze this on any time frame. It can do it on stocks, futures, forex, commodities. It doesn't matter, cryptocurrencies. And so what I'm going to do is I'll give you guys this cheat sheet that I have of the six, and including my 5-step approach that I use right before I'm selling, because I want to see 5 things happen to each candlesticks, each one of these 6 candlesticks. 5 things have to happen in order for me to say, yep, I know it's time to buy, or yep, it's time to get out of the trade. Okay. Then I'll also go over at the workshop itself how you profile a candlestick. This is another big reason. I was attending a webinar once, and not a webinar, a live event. I was invited to come speak at a live event. There was multiple speakers there. You know, I spoke, and then after I spoke, the next speaker came up, and the next speaker said, you know, oh man, that was a great presentation that the previous speaker referring to me did. But my reason for why I don't like candlesticks is because they only work 60% of the time. It's a 40% of the time. And as soon as that speaker said that, I knew exactly why they would say that. It's because they've made one of the biggest mistakes that people make when it comes to candlestick signals analysis, which is they don't even know how to profile that candlestick, because certain candlesticks work well with certain stocks. And if you don't know that, it's probably one of the biggest reasons why candlesticks did not work for you. So once you understand how, and it's a very simple process, it literally takes 5 to 7 seconds to profile. Well, let me rephrase that. At the very most, I'm talking about 30 seconds, you can profile a stock and a candlestick. Okay. It doesn't take that long at all. So that way, whether it's your favorite stocks that you like to trade, to say, hey, now I know which candlesticks work with this favorite stock of mine. And then once you know it, it's like you don't have to worry about anything. Any other candlestick that appears is just a counterfeit candlestick. And you only focus on the ones that you know. So I will show you how to profile stocks, which one works best. I mean, this alone is worth everything that you come into the class for if you're a candlestick trader. If you want to know, I mean, when I hear an article, somebody says something about a stock that is ready to go up and this and that, I can just go to the stock. If I never seen the stock before, within 30 seconds, I can analyze, okay, here's a candlestick that works well with it. Now, let me see if this is one of those that's happening right now. If it is, great. I believe that article. If it's not, I don't believe that article. Okay. And that's simply it. You will also get my email alerts. I'm going to send you my email alerts. Now, I don't send out emails every single day. Okay. I send out emails when I see really, really good setups that I know I'm even interested in getting into. Okay. But I will include you on my email alerts so you can actually see here are some of the emails that I sent out to some subscribers previously. This is the one I sent out on Tesla back on December 10th. Excuse me, so Tesla's daily chart today has confirmed a bullish trend. Setup like today is usually a good time to add to existing positions. You can go back to December 10 and see what was happening in Tesla, and you see that from that point, I think Tesla was around $350 at that point in time, went from 350 and surpassed 500 bucks. Okay, this was the email I sent out back then. Now, some of us were already in Tesla before, so that's why I said this is a good time to add to your existing positions. Does that make sense? Here's the one I sent on December 24th. When I saw it in gold, I said gold, gold, and more golds. Today's stock alert is gold. Yesterday, I talked extensively about the setup we were seeing. So we had already seen the setup the day before. And it just so happened that it was on the day that I was on a live webinar. I said, look, we talked about it. Today, we got the confirmation, guys. If you don't get in, you're going to miss out on this. Okay. That was on the 24th. Most people are asking, should I get into gold now? And then one other thing I'm going to add, I'm going to add 2 more things to kind of like just like, if you join me, I'm going to give you so much information that by the time you're done, it's like you would have the tools available for you to help you navigate through any market. The other issue I hear about a lot of people saying is volatility. Volatility. There are people that are so scared of volatility. Well, in my research, we got to a point where we're able to even identify when volatility is over. See, most people talk about volatility. VIX, you all heard about the VIX. So I have a video that I put together about the VIX. And in this video, I talk about how you can tell when literally the day that the VIX has, the VIX volatility is over. And if the VIX volatility is over, it means that it's telling you the market is getting ready to go higher. Okay, this right there. I mean, for anybody who's worried about volatility and the market's being manipulated and all that stuff, how would you like to be able to see visual representation of when volatility is over? Because you never hear people talk about, oh, volatility is over today. They can tell you volatility ended 2 weeks ago, but to tell you, hey, today, wow, I just looked at the chart today, volatility's ended today. Being able to see this, so knowing that volatility's ended today, and then being able to get back into the market and start trading is like humongous advantage. Okay, here's what this one student did. This was back in December 26. You remember when we were looking at the chart of the S&P 500 on the 24 market, we're looking back on the 26. Now notice what this is. This is at 9:50 in the morning when he sent me this email. He had just taken my course on VIX, and he had just finished watching it. And then, if you read the email over here, here's a part I want to point out. He said, if I understand the VIX, because he had just literally watched it, he said, if I understand the VIX video, we should soon see a downturn in the VIX, meaning that the VIX was going to end, which would indicate that the stock would rise. The spike in VIX was going to end and the stock market was going to rise. That's what he said at 9:50 in the morning on the 26th. So the day wasn't even over yet. The day market has only been over for 20 minutes. And he like, wait a second, am I seeing this right? What you talk about is literally happening right now. This was what the chart looked like on that day. I went back and took a screenshot. This is what the chart was looking like on that day. Most people are looking at this like have no idea what's about to happen. And this is when he said, wait a second, if I understand using your VIX video, we should be expecting this market to rally. Okay. By the end of that day, this is what it ended up being. Market went to all-time highs. How was it that he saw that same day? Simply because of what I cover on my VIX volatility video. Again, you don't see people talking about today VIX has ended. You hear them talk about, oh, VIX is spike, VIX is spike, VIX is low, VIX is low. But to say, wait a second, after the spike, this is the day that is ending. To the day that VIX is ended. I'm going to give that to you because I think if you understand that, then again, taking away all your fears and emotions about whether or not should I be buying and all that. So when you add all that together and then you start seeing the right side candle, can you see why now we say, wait a second, VIX just ended, so volatility is over. We just registered one of the strongest trending signals that is about to occur. I was like, can you understand why I now say sell everything you have and go buy because we know the market is getting ready to go higher? All right, here's what this person says. Wally, you're the best chartist. Everything that's happening in the market today, I saw it coming last week because of your VIX video. All right, and this is what he says. So let me just fast forward because I only got 2 more minutes. I kind of want, what else do you need? Most of the time people ask me, well, how do you find some stocks, some trending stocks? So this is my last thing I'm going to offer to you guys too as well. I said, look, how are we finding these stocks? When we know the market is getting ready to go higher, how can you tell which ones? We have a software. This is 1-800-Flowers. This is a stock that I just literally started talking to my team about and my students about, saying, hey, get ready for 1-800-Flowers. Because we know that in 1-800-Flowers, this is what 1-800-Flower does over time in the month of January. And now we're beginning to see some of those signs. And I said, look, in the last 10 years, from January to February, 1-800-Flower has gone up 10 times out of 10. Actually, the record is even more than that. It's actually in the last 12 to 13 years. Okay, so once you start knowing certain stocks that are ready to do something and you start seeing those signs, it's like, wow, the signs are beginning to show. It's like, wow. I just had a lady that was in my office earlier today. She's like, man, I'm already in 1-800-Flowers. I told my wife, I said, look, your Valentine's present is going to come from how well we do with 1-800-Flowers this year. Okay, so when everybody's ordering 1-800-Flowers and delivering flowers, I'm investing in 1-800-Flowers because I know some things about 1-800-Flowers that most people are not paying attention to. And then that's what you get. So all this being said, you will get access to my software for 30 days. If you look at everything that I'm offering you right now, is about $2,000. But today, what I'm going to do, oh, this is another testimony, but I won't even go. I think you guys have got enough on this. For $299, all this stuff that I just told you guys to help you change the way you trade, you come into the webinar, you get this for $299. Okay. Now, I'm going to do one last thing before I sign off, and that's this. I want to have those who are willing to take fast action. If you decide to take advantage of this before midnight tomorrow, I will knock out another $100 from the original price of $299. Okay, so you can literally come in, you'll get everything we just talked about. You get $100 knocked off again after. Now, you can still sign up after Friday, but I'm just saying for those of you guys who take the action and go in and go through this between now and before tomorrow night ends, you can get it for an additional $100 off. Okay, so you get it for $199. If not, after midnight, you'll see, you come Saturday, you'll see it back to $299. Okay, so again, the price is $299, but again, for those of you guys who take action now, you'll be able to get in for $199. Thank you so much for your time. I really hope that this sheds some light. Look forward to seeing you guys on Tuesday night. Thank you. I'm going to go ahead and turn it back to Anna.
Great. Okay, good afternoon, everyone. Here it is. Very cold day here in New York and bullish market making brand new all-time highs here right as we're speaking. SPY is up and I'm waiting momentarily for the market to break out. Could happen today into the close, could happen and continue tomorrow. So again, as I was stating, 2020 has been a very bullish year in the market. Now, it's interesting though, because I tend to like to look at shorts for the day trade side. And I also do options, and I may do calls or puts in the options. Today, we're going to talk about my system, the system that I personally created 12 years ago, which does have great results. So I would say out of every 10 trades that I call, you figure 2 are going to lose and 8 are going to work. There's no system that's 100%. So that's why when I take a trade, I put in a stop. I put in a limit order shot for the day trade, and for options, basically the stop is the amount that you risk depending on how many contracts you take. If you have any questions, you can type them in the room and I will see them as we go along, okay? And if you have questions afterwards, you can always email me at melissa@drstoxx.com or call me at 929-3200-GAP. And you can follow me on Twitter, Facebook, YouTube, or Skype. I appear on Fox News and Fox Business Network, so sometimes you will catch me on television. So 2020 is here, okay? And again, 2 weeks into the year, we are full on into January. Hopefully everyone so far to date is adhering to their New Year's resolutions, whatever they are. And if one of your goals for 2020 is to actually be successful and actually make money in the market and maybe even do this for a career, then it's time to get on board, okay? So whatever you did last year, if you lost money in the market, you need to turn it around. I call it have amnesia. Do whatever you need to do so that you forget about the mistakes that you made in the past. But it is imperative that you do not carry bad habits or bad systems into this calendar year, okay? The only way that you're going to do something different this year is if you actually change the trading strategy or system that you're using. A lot of times people blame themselves and say, well, I have terrible money management. While it's true that you do need good money management to trade, that's kind of like trading 101, okay? You don't need to take a class to understand that you need to have good money management. That's just like the basics, okay? But what I find a lot of people lack is they lack a consistent winning strategy or system to follow on any given day. And I follow and do the same thing pretty much like clockwork every day, okay? And what do? I focus on stocks that are gapping. It is something that has big enough momentum and big enough moves that you could trade as your full-time job if in fact that's what you want to do. But ultimately, no matter what you choose to do, if you want to trade part-time or full-time, you have to make money. Although trading is fun, and I personally love reading charts, I love making money more, okay? So making money, it has to be the goal and the reason why you trade. If you're losing, as fun as it is, it just doesn't make any sense if you're losing money year over year in the market. And any questions, again, you can type them in the room and I'll see them. So trading really is a skill, like juggling, playing a musical instrument, playing a sport. A lot of people, even to this day, want to buy like a system and just plug it in and just have it beat one to take a trade and beat one to get out. What I do, I use my mind and I use my brain, which by the way is the best asset that any of you have as well. But you need to cultivate it and you need to learn what to see and analyze correctly using your brain. It is a skill. It is a skill set to see price action and predict price action, which is actually called forecasting. So that is what I do. I forecast the direction of a stock by looking at the gap and analyzing it and saying that this is the next direction that it's going to go, or the market. Just like I told you right before we started. Just like I said 2 minutes ago. I said the market is at new highs right now. We're going to break out between today and tomorrow in the next 24 hours. Okay, so I just predicted market direction for you. It is a skill. It's a skill set that I've cultivated over the last 12 years, and it's based on my analysis of gaps. So the market today in the SPY gapped up, and I'm reading that as bullish and that we are going to rally and that we are higher. Okay, and any questions, I'll see them in the room. So it's always a good time to think about this. What are you going to do differently this year than you did last year? If you did not get the results that you wanted in the market last year trading, what are you going to do differently this year? For me personally, I find the amount of time that I prepare in the morning to get ready to trade is the most important time of the day for me. So I prepare, choose what stocks and picks I want to trade, and I look at the market and analyze it in the pre-market in the morning, way before I'm even in anything and way before the market opens. Or if I happen to be in something, then I'm preparing and deciding what I'm going to do with that trade on the day. If I'm in an option, am I going to sell it that day or sell it into the open or sell it before the close? Okay. Or am I going to leave it on? Again, these are all the things that I look at in my preparation before the market opens, because in that moment that the market's live and the hours of the market between 9:30 and 4, you're usually very focused on trades that you're in. I make the decisions what I want to do in the pre-market when I'm all relaxed and I have, time to prepare and time to do the analyzing. And that's when I'm taking the knowledge that I have and putting my skills to work. So it's just a good time of the year, still very early in the year, to take good new information, knowledge, and a positive outlook ahead to get the results that you want for this year. And I always tell people this, they come and they say, oh, Melissa, don't be afraid to use your brain. It's one of my best assets, okay? If you're not used to using your brain, then get used to using it. Your brain is a muscle. You work it and you work it and work it, like when you go to the gym. Sometimes you might want to think so hard that you'll get a headache. But guess what? You get smarter and smarter as time goes on, and that's how you grow. That's how you think more, and you can think through things and solve problems and do them in a low stress environment, which is where you're not under the gun, where your brain is under stress and then you make mistakes. When you train, the only way you're going to make money is by taking risk, okay? So that's just, again, trading 101. You're not going to make any money at all. You're not going to make any profit unless you take risk. And the more risk you take, again, more share size, more contract size, more quantity, the more money that you can make. If you take 5,000 shares of a stock and you go long it and it rallies $1, your profit is what? $5,000, which is a lot more than if you took 500 shares. You may have more stress if you take 5,000 shares because your risk is more. But if you understand why you took the trade, if you have 100% conviction in the trade, if you have the knowledge and the right system, you won't feel stressed about taking the trade. You'll have the conviction, you'll have the full-on understanding, which is one of the reasons why I think it's important for people to understand what they're doing before they take any trades with me. People must take my class in order to join my live trading room. Now, I do offer trials. If you're interested in a trial to the room, you can email me for a trial, okay? But everyone that's in my live room where I'm calling the trades daily, like I called the market today, has done my class, so they have the knowledge, all right? So trading, day trading, or options trading, whichever you want to do, is something you can do from home, and you can also do it from anywhere in the world. Now, why do people find trading so hard? Personally, I think it's because, to be honest with you, there's just an overwhelming amount of information out there. And then people don't know what to follow. They don't know what is right. They don't know what is wrong. They don't know what to be focused on. And so people are all over the place. So market also can be very volatile. I don't think it is right now. And I don't think it was for the last couple of months. But sometimes we have volatility in the market, and that scares people too. But I think it's really the lack of focus and the lack of clarity is the main reason I think why people find trading difficult. For me, I get up in the morning, I rate my gaps, I choose my stock picks or I don't like anything at all, in which case I don't trade. So I'm not looking at 10,000 different things and then, flipping back and forth. I also never go long and short a same stock on the same day. That would be zero conviction to me. So I'm very, very focused on what I'm doing. Usually 1 or 2 or 3 ticker symbols per day. And again, only in one direction, whatever that happens to be. So I have conviction in what I'm doing. Or if I don't do it at all. But people lack focus when they trade. They don't focus on one system. And because there's an overwhelming amount of information out there and people are getting bombarded by emails and things on the internet, I totally get why it gets to be confusing for people. But without the lack of clarity and focus, you're not going to be successful and you're never going to make a lot of money, if in fact that is your goal. And I mean, if it's not your goal, that's fine. But if it is, you're never going to get there if you don't have the proper focus, okay? For me, I focus on gaps. So let's just do a basic review here of what a gap is. So this was last year, 2019, October. This was McDonald's. This was earnings. The stock had an earnings move. Stock closed here the night before. Earnings, boom, gap down. Stock closed at one price up here around 210 and gap down here around 205 and change. This is a gap down. It's a bearish gap. So the stock closed here at 4 and opened at 930. That's what a gap is. Stocks can gap down. Stocks can gap up. Here was a gap up in McDonald's. Rally. Stock closed here, opened at a higher price. So the U.S. market has a close at 4 and an open at 930. Close here at 4, open at 930. So there are bullish gaps and there are bearish gaps. I look at both, okay? Although I prefer to short. If you had to ask me, I prefer to short, and the reason is because selling action happens faster and quicker and more panicky than bullish action. It's rare to find something called panic buying, although I will tell you that is what happened in Tesla in the last week. We had something that was very, very rare as an anomaly. It was called panic buying. I talked about that Monday on Ameritrade. But most of the time, 99.999% of the time, panic comes in selling action. And that's what happened here at McDonald's. This was a good short, or you could have done a put. But what I do is I look at the gap, see the gap in the morning to determine if this is a long or a short. And in this case here, McDonald's was short. It's obvious now the day was done, but we were in here early in the morning, and I can see it usually in the pre-market. And again, any questions, you can write them in the room. So for me, I like to day trade in the first half an hour, in and out quickly, okay, preferably 5, 10, 15 minutes in and out. And when you're day trading, there's really no overnight risk because you're flat and out of all your trades before 4. Now, if you do options, you have the risk of the contract of the position, which could go in your favor or against you overnight. But you have the protection. It's like the insurance where you're not going to lose an endless amount of money. If you take 10 contracts of something and it costs $1,000 or $1, that's all that you would lose. $1,000. You wouldn't lose any more, even if it goes way against you. That's the maximum amount, okay? So the way that I look at it is I'm trying to be always in control of my money, setting the risk, putting in the stuff, okay? And I'm in and I'm out, just like that. You're chunking it out. That's what trading is. Trading isn't investing. You're not buying a stock today and holding it until June of 2020, okay? That would be way different. Now, again, you could look at a chart, look at the gaps, predict the directional bias of something by June using my system, but I'm not really taking trades that way because if you want to make money, you have to book it. The money isn't yours even if you're up until you're out of the trade and it's booked and it's in your account. So this is not passive investing. It's active trading where you're in and you're out. And I think that's different for some people. Sometimes people, I think, want to hold. They want to take something to buy it and hold it. That's investing. This is active trading. You can make more money trading than actually long-term active investing because you can take many, many trades, get in and get out, get in and get out. You can turn your money over faster, okay? But people find long-term investing easier because they don't have to watch it every day. I think it's fun to watch stocks in the market every day, okay? But you do have to have an interest in it. And you do have to have an interest in looking at charts because as I said earlier, what I do is based on technical analysis, which is looking at charts. All right. Anyways, if in fact you want to do this for something, for a career, again, break it down. Make it more realistic for yourself, whatever your goal is. If it's $250,000 a year, break it down per month, per week, and per day. It doesn't mean that you're going to make exactly $1,000 per day. Some days you may make 500. Some days you may lose. Some days you may make 5,000. On average, though, you should have an average per week or an average per month. This will help keep you on track, and then you back it out to determine your risk. I say usually every day trade, you're looking to turn it over one. So if you risk $2,000 per day trade, your goal is what? Around $2,000 per trade. And again, I try to focus on one trade a day or maybe two. There are different kinds of traders, though. There are options traders and there are day traders. I'm not sure what you prefer. You only need $2,000 to open up an options trading account, and options are not based on margin. You need a minimum of $25,000 to trade on a margin account at a retail account, unless you go to a proprietary day trading account where you can actively day trade on margin. They'll usually give you 10-to-1 margin, and you can open up an account with as little as $2,500. There are different types of brokers. If you've never heard of those or you don't know, you can Google it, read about it, or email me if you have any questions. But in today's environment, in today's world, pretty much almost everybody out there has a possibility or the chance to trade. Again, you have to have money to open up an account to trade, but it's very accessible to many people now. It's not just for rich people to actively trade the market, which it was really years and years and years and years ago. Okay, so again, this is active trading is different than in long-term investing where you have to have the cash or you have the cash and very little margin. But when you're doing options, you are in and you could hold it or you're out. You can day trade margins. When we're doing the day trading, okay, it is in a margin account. Again, usually 4-to-1 or 10-to-1, all right? But my system can be traded with any size day trading account. You could risk $100 per trade. You could risk $1,000 per trade. You could risk $5,000 per trade. The amount of your risk should be in accordance with the size of your account for the cash, regardless of margin or where you're trading, okay? The most important thing, though, is learning the knowledge first, which allows you to take the risk so you make sense out of it and can be profitable and do well. You have all the time in the world to make a lot of money in the market. Again, it's just the beginning of the year. There's no reason to be heavy-handed if you don't know what to do or you're new. I also don't trade penny stocks. I think they're junk, and we don't do any low float crappy stocks that are worthless. Okay, most of the stocks we do are companies that you know, Facebook, Google, Amazon, BBBY, things that you would have heard of. Okay, here's a company you would have heard of, Six. Okay, so this was a trade last week. This was a day trade. So let's go over the gap. Stock closed here the night before around 43.50. Boom. Opened in the morning around what? $37. So the stock was gapping down. In the pre-market, I looked at the gap to determine if Six would continue lower, in which case it would be a short, or if it was going to rally, in which case either I wouldn't have done it or theoretically you could have gone long it. Anyways, I looked at the gap and I said, this is lower, and it did drop. So it opened here around 37. Low down here was around 35. 35.10, I think, was the low. 35 was really the target of the day. Went to 35.10. This was a short. I don't know what this is doing today. But anyways, here's the 1-minute chart, which really shows you the gap down. Stock closed here, gap down. Boom. You could have shorted it out of the gate, got the drop. We ended up doing it a little later in here. Right in this spacey base, we shorted it, got the drop. And again, I squished these and made these bars really small. This is a 1-minute chart. This is a daily. So on the daily chart, I used my system in the pre-market to determine, one, what stock I want to do, which in this case was Six, or watch, and two, what direction to do it, which in this case here was a short. So this was, I was predicting it was lower. I was right. Then on the live day, I'm never in it in the pre-market in the morning, and I'm not in it in the post-market at night. I'm waiting to determine to see if this is going to set up, which in case this did. This had a couple setups. And anyways, long story short, this was lower. So we shorted this, okay, on the setup after the live day. Here's the open, okay? Here was the trade. Entry was 35.58 on 4,000 shares, which is an advanced trader risk. I say that's an advanced risk, okay? Stop was 36.15. Remember, I always put the stop. Risk is 22.80. Exit at 36.15. This was a loss. So the first trade we did in 6 stopped. I'm going to go back and show you this here in a minute. We were in it down in here, snug as a bug in a rug. First trade in this was here. I didn't get this initial one here. I saw it late. We missed it. Anyways, I did it here, put the stop. I got stopped out. It ended up going to work. I'm going to show you the second trade of the money in it, but this trade stopped. But it was still good to use a stop here. Why? What if this would have failed? What if it would have ran all the way up here $1? Then I would have lost $4 grand. So it's okay that it got stopped. I thought it would immediately continue lower. I was wrong. It took about an hour or so to continue dropping. But I'm just showing you still the importance of putting the stop, because if this had flipped, gone over the high, it would have went all the way up over 37, and it would have been a massive loss, okay? So again, you have to have parameters. So this trade stopped. Then we did something called a retake. Now, what is a retake? I stay on top of it. I still like 6 lower. I still really, really liked it. It was lower. Anyways, entry on the second trade, second setup, still in the morning, was 35.99. Shares was 5,000. Stop was 36.50. This is still a really good stop for this price point. Okay, about 50 cents or thereabout, 51 cents. Risk was 25.50. Then it hit again, same point, 5,000. Hit it again. I'll go back to the chart and show you this in a minute. Total shares 10,000. Again, price the same with the entry, with the retake. Exit 35.18. This was a big trade for 2 reasons. 1, beautiful entry, good stop, and the size. So more than made up the difference for the initial stop, and then still a profitable day. Now, what happened here? And again, I squished this because I wanted you to see. Here's where we did it right away. Took the stop, then it based out, then we shorted it, then we added a little bit more before the breakdown, got the drop. So this is a day trade short in 6 from January 10th. Okay, does everyone see that? So the first trade was stopped. The second trade was a win, and it was still a very, very profitable day. Any questions on that? Let's look at another one here. This was on Monday. So that was the 10th. This was Monday the 13th. Again, this is a gap down. Stock closed here, gap down, open, dropped. This was EXAS. Stock closed here around 104 and change. Boom, open in the morning around 95. So I got up in the morning and I rated the gap to determine, 1, if I wanted to do EXAS at all, and then 2, to determine if it was a long or a short. So I determined it was a good gap and it was a short. So I was predicting this was lower, and this ended up having a huge day. So what did it do? Stock closed here. This is a 1 minute, gap down, open, fell, boom. This hit almost immediately. Here's the first 5 minutes of the day in EXAS. High up here is around 95 and change. Low in here was around 90. Actually, basically went down to where the low of the day was in the first 5 minutes of the day. This went to the dream target of 90. We captured this here. This moved so quick, so fast. Some people got it here in the second bar. Then some people got it here in the third bar. Either way, this is a beautiful move. And you could have redone it. You could have taken it again and redone it. Anyways, here was the first trade. 92.69 entry, 1,500 shares. Stop was 94.65. Risk was 29.40. Boom. Exit on the bounce, 90.16. Profit, $3,795. And this was in less than 5 minutes. So it was a beautiful, beautiful, beautiful sell-off that happened right out of the gate. My bias on this, based on reading the gap, was going to sell off. And then as soon as I saw it and it set up, boom, reacted. And this was even a late reaction, to be honest with you. But it was good enough. It was a big, fast, $2 plus move immediately right out of the gate. And that is literally all you need on any given day. Okay, now again, this is an equity trade, this is a day trade, this is not an option. Although you could have done an option theoretically in this, you could have bought a put if you wanted to. I think this was a better day trade. I did not call a put in this, okay? Any questions on that? So the point I was trying to make about reviewing some of the last few trades is that not every trade works, and not every trade has to work, and you can still make good money. It is about odds. When I get up in the morning, I have a 26-point rating system that I use in the pre-market to choose the stocks I'm going to trade. And I look at the odds. If it's high odds, then we do it. If it's low odds, then we don't do it, okay? But even if I look at something, and even if I like it, like the 6, the setup in that failed in the first trade stopped. So again, you will have some trades that lose, but if you keep your risk amount similar or close to similar in every trade, you're going to be fine, because you're going to be profitable, because some trades will end up being very big trades, number one, which was the second 6 was. And then number 2, some trades will work immediately and go right away and be big trades, like EXAS was. That did not stop at all. It was a huge move out of the gate, and we got it. And you would have really had to be watching that stock and had to have seen it in the pre-market to get that move right out of the gate. And if you did, you could have made, $3,700 and been done for the day by way before 10 o'clock. So I'm typically trying to look for that every day. And one of the reasons that I was saying that I prefer shorts is because short moves happen so quickly. Like today with the market, you have to wait sometimes for things to rally. You got to wait for rallies. Any questions here? But for the most part, you can move forward, and whether it's grow your account or make more money over time to pay yourself and increase your risk to step it up, you have to chunk it out. Because like if you have an account with say $5,000 in a profit account, you can't risk $2,000 in a trade. That would be ridiculous. You'd be risking almost half your account in a trade. That would be insane. And I know sometimes people do that. That's crazy. Now, if you did it in Tesla, you made out like a banshee, but that still would have been dumb, and you can't do things like that. So you chunk it out. You chunk it. So if you have a $5,000 account, you start out, you risk $200. You build the account up to $6,000. Then you can bump it up to $300 a trade. Then you bump it up to $7,000 you got in your account. Then you can bump it up to $400. Then you get $10,000 in the account. To use to trade, and then you bump up your risk to 500. And I'm talking about a prop account, and that is how you do it. And it doesn't have to take that long. It really doesn't have to take that long, but you have to have the patience to go up the ladder and take the necessary steps to get there. I know everybody wants to jump up and down and make $1 million. Not today. Everybody wants to make $1 million yesterday, and they want to do it with no money and no risk. I always think that's hilarious. In fact, somebody emailed me a ridiculous question the other day, and I said I'm never surprised by the questions that people ask. People really, I never shock me anymore about their expectations and what they expect. People literally expect to make a lot of money, risking nothing, and really doing nothing, like not using their brain whatsoever at all. You do have to use your brain. So what? What's wrong with that? Nothing. Okay. Some of the most successful people in the world are people that have amazing brains. And I'm not saying that your goal in life is to go out there and be Jeff Bezos, but let me tell you something, that man has a good brain, okay? So when you think about it, if your goals are very lofty, whatever they happen to be, okay? And lofty means could be different for things for different people, okay? Whether it's time, whether it's with your starting capital, whatever, okay? It's not impossible. You can do it, but you have to think. You have to think, and you have to have the right knowledge, okay? The knowledge helps you. If you have $1 million and if you don't have the right knowledge, you can lose it all. If you have the right knowledge and you have $1,000, you could turn that 1,000 into $1 million. I don't know how long it will take you, but you could. It's unrealistic to think you could do that in a month. And that is part of the problem. I think a lot of people have completely unrealistic expectations within the time frame that they think they can achieve certain results, and then they make poor choices in order to try to push the results along faster when it's not meeting the required time specifications. Okay. Any questions here so far? Anyways, let's talk about share size to make a living. If you risk $1 or 1,000 shares, you're trying to get a move of $1, $2. You know, every time I go in, I'm like, okay, well, I'm trying to get a move. I'm trying to get $1. I'm trying to get $2. And again, I'm talking in general. This isn't stocks like Amazon or Google, which we're not day trading, even though we do options in those things. In general, 50 cents $1. Okay, I'm trying to get things that move. But this is a nice job if you want to do it for a living because you can work from home. You can be anywhere in the world. And if you want to do options, like I said, you don't need a margin account. You can do it with a cash account. So what does that mean? Say, for example, you have a margin account. It costs $39 a share for the stock times 1,000 shares. Really, the cost of the position is $39,000 to take it. That doesn't mean cash. It means cost. It doesn't mean you need $39,000 cash. It means you need an account with that buying power of the 39 grand. So, for example, if you have a 4-to-1 margin account, you need 9,750. If you have a 10-to-1 margin account, which you can get at proprietary day trading firms, you need 3,900. I'm just using this as an example to show you. Now, what if you wanted to buy the stock, this same stock, but you didn't have any of these things, and you said, well, I'm going to do it as an option. Say you wanted to do EXAX as an option, which I didn't call, but you could have done it, all right? Say it cost $1, okay? That would be a lot different. You get 10 contracts, which is basically like 1,000 shares. If it costs $1, you would need $1,000 cash, and you don't really necessarily worry about margin. So these are the pros and cons of doing options versus equity trading. I find the benefits of both. You have to look into it. If you have questions, call a broker, or you can email me later. Okay. Now let's talk very quickly here about the trade of the month. I don't think anything is going to top this. In fact, I'm certain that nothing will top this. This is going to be the trade of the month for the stock swoosh right here. I have a very good eye. I have a very good intuition. I built that intuition and my eye and my instinct based on 12 years of doing the same thing. But it started out with the right knowledge on gaps. And over time now, I've just gained a sixth sense to do this. Is that something you can come and get from me? Yes, once you learn my system and start to do it and trade with me in the room Monday through Friday over time. How long will it take you? I don't know. Until then, you take the trades as I call them and you learn the class and you start to do it and you don't deviate from the system, which I don't do. Luckily, I ignore everything everyone says but myself. So the reality is that Tesla was higher way back here. I did do an option in this back here I called in October, and then I just kind of let it be. Didn't really look at it, didn't do much with it, didn't call anything here in December. The stock was on the move. Then on this day here, just was, again, I saw it was going to gap up. This was on a Monday. It was January 6th. So I called the 450 and the 455 calls in Tesla, expiring that week on the 10th. This was last Monday or whatever. It was more than a week ago now. And it worked. So I called it very late in the day because I saw the stock was getting bought and I saw it was going to gap up, and I was right. So this was the day I called the first two trades, and then it gapped up over the strike. A lot of times I'll call these options trades, whether they're calls or puts, and they'll gap into the direction through the strike of the day that I call them. So theoretically, you could have got out in the morning with profit here. Now, if you held it, it had a move of the day here and a move of the day here, and I called more trades here and more trades here, and they all worked. So this was the big breakout day. Right in here, it was the 8th, I think. Anyway, stock almost made it to the dream target, which was 500 last week. It did eventually get to 500 this week. I'm not going to go over any of those, but if you did an advanced risk, a total risk of all the trades I called was $87,880. You could have made $336,720. And actually, some of you could have held even longer into the following week with the lift that it had. But anyways, average return on investment, 383%, which is fantastic. It was the timing of the trades that I called. It was twofold. One, the momentum in the stock, and the timing that I called these trades. I had perfect timing on these trades. I had absolutely perfect entries. I couldn't have done this any better if I tried, unless I did it out in December. But the reality is the cost of these trades would have been more if we had bought them in December than they were in January if I did them for January expirations. So typically when I call trades, I call trades within a 2-week period. Could be the week of, could be 2 days away, could be 2 weeks. I typically do not want to take stuff far out. I don't think there's any benefit necessarily to doing that. Again, as an active trader, you're in and you're out and you're in and you're out. I only have about 10 more minutes. So I'm going to try to go through this stuff really, really quickly. But again, I know this is being recorded. And if you have any questions, you can email me as well. Anyways, here was the Monday. So I called the 450s and the 455s, sent the trade out at 3 o'clock. The options newsletter, you get the trades emailed to you. Okay. And again, cost on the Monday was 6. It was ran up. Beautiful trade. Sold at 42, 600% return investment. I showed you the chart. It ran straight up like a rocket. Then the 450s were very good as well. Okay. Again, straight up trade. Ran right up that week. Gapped up the next day after I called it. Then in the morning on the 7th, 9:42 a.m., I called the 460s. This was a good trade too. Okay. That one ran up as well. I also called right away to the 470s. So typically what I do if I see something running, and I know, I'm like, I can see the momentum. It's going to go here. It's going to go here. So then I'm calling it. Called the 460s. Called the 470s. This was a really good move from the cost. Cost of this was only $3.60. It was a 705% return investment. That was the 470s. Then I called the 475s. That was huge too. Again, I called them at noon or close to noon on Tuesday. Okay, this is the second day. This is before the day it took off like a rocket, which was the 8th. Okay, so I had perfect entries on these. Then again, I called around 12:30, the 480s. And then I called in the afternoon, 2 o'clock, I called the 500s, which was insane, but it actually got there too. Okay. And I called then the next day, I called as many as we could do. 485s, I called the 490s, and I called the 495s. This was Wednesday morning at 7:30 in the morning. I knew the stock would continue higher that day. And I'm just going to go back and show you this chart really quickly. So that was the morning of here in the pre-market at 7:30. I knew this was going to go, and it did. So again, I have a very, 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 very good eye for this. And it went. So people were short this, they shouldn't have been. People were short it last week. It broke out again. I called more trades. I don't think I have those in here. There just wasn't time. I'll do a video eventually on my YouTube with those other trades, but I called more trades on Monday in this Tesla. So Tesla, just everybody made a lot of money in it. One girl told me today she's up $70-some thousand to start the year. I mean, it's just like ridiculous. But again, I had perfect entries on those. It was a perfect read of the chart. And again, when you see momentum, when you see institutional selling or you see institutional buying, when the knowledge tells you the trade is good, you set your risk accordingly, which would be based on the size of your account, and you take the trade and you let it play out. Some trades I call go right away like those. Some trades I call are down before they go. It is what it is. I use the same system no matter what, whether I'm doing longs or shorts or day trades or options, it's the same exact system. Okay, everybody that did the Tesla trades I called made money, went last week into this Monday, and now we're watching it here to see where it goes as well. But the point I'm trying to make is you may have big goals, but you can achieve them, but you got to have the right knowledge. Like the woman that's happy that she made over 70 grand, she's astounded. She's been working on getting to that point, and now she's there. You don't know when you're going to get to that point. It's like, but you know that you need to take the right steps to move forward to get to that point. And too many people, like I said at the beginning, jump around from thing to thing to thing to thing. What I do works. The question is whether or not you want to come and be committed to learn from me, because the cost of my class is not cheap. My class is $69.99. It's $7,000 if you want to learn what I know. And if you just want to get the options trades, it's $6,000. It's $59.99 for all the trades for a year. So you're going to pay a premium. You're going to pay a good amount of money to get those trades. And if you want to learn it, it's the best case scenario, because what are you going to do if 10 years from now, I'm not teaching people this anymore and I'm off running a hedge fund, which I've seriously considered doing, especially in the last 2 weeks, the way I've been calling the market and stocks like Tesla, because you add about 5 more zeros onto those numbers is what people make that are running funds. The fact is that the market is moved by institutional money, whether it's selling or buying. And when traders try to do tricky things, they tend to lose. You may take 10 trades and make a lot of money in one and lose on the other 9 trying to duplicate what you did, because what you did really wasn't a good trade. The worst thing you can do is make money in a bad trade. People don't understand that, but I'm telling you, and BYND, I don't really have time to talk about that today. That's another tricky one. That's another one that people are going to get hurt in or have gotten hurt in. But anyways, I use one strategy to trade. I focus on gaps. We get gaps all time of the year, but right now earnings season is upon us, so there's lots and lots of gaps. And I say to people, focus on right now what you can achieve. Live in the moment. If you want to make thousands of dollars, you can do it. But right now, is that possible? It is if you have the cash to risk and take my class and learn. So you have to look at where you're at right now. You will get there. Think positive about what you want to do, but pushing the envelope or believing in fairy tales, like taking $500 and making 20 grand in a month, is ridiculous. Once you get with reality and are focused on really, truly achieving your goals with reality, which doesn't mean you can't make a lot of money. You absolutely can. That can be your reality, even if you have a small amount to start. But you have to have the right knowledge. Without it, you're lost no matter what anyways. You're lost, like I said, even if you don't have $1 million, you're lost without the right knowledge and the right guidance, okay? The knowledge gives you the conviction to take the risk and put on the trades, all right? So think about what I said today. Think about if you have time to do this. Think about if you want to trade full-time or do it part-time. Think about the things you did last year and the changes you're going to make for this year. But you absolutely can make money in the market if you want to. So I teach a class. It's called the Golden Gap Course. It's a rating system. It measures gaps by rating them in the daily chart to find stocks to trade that have, number one, a high probability of directional bias to follow through for the entire day. Two, big move on the day, preferably. Early confirmation of the bias, and the move between 9:30 and 10 a.m. Okay, precise entries with follow through and a good risk to reward target potential, which is exactly what I did with Tesla. So you can do this if you want, if you're interested. When you get in good trades, the money comes quick and easy. When you're in bad trades, it doesn't. So you see the difference. And again, a lot of people just aren't focused on the right stuff. The Golden Gap system is a 26-point professional bearish gap rating system, and the purpose of my system is to help you evaluate which gap to trade each morning using a checklist. You do this in the pre-market. Excuse me. You do it in the pre-market. But I'm not taking any trades in the pre-market. You can't take options in the pre-market, one. And two, I'm not doing equity trades in the pre-market because they wouldn't be on 4-to-1 margin. Okay, they would be like, it would be like an entry, like where you would just be taking the position either on 2-to-1 margin or on no margin. Okay, I'm not doing that. This checklist, though, that I figure out in the morning tells me what to trade and in what direction. And it predicts the directional bias in the stock. So really quickly, I'm going to go through the next class. If you want to learn, is January 25th and 26th. 9 a.m. to 5 p.m. Eastern Time. Cost of the class is $69.99. If you're interested, email me. I'm doing a special, starts today through Monday for Martin Luther King. This is the trading room and the options letter free until the end of March, which is basically the whole earnings season. You're going to get all the options trades, all the day trades, be in the live room. This offer ends on Martin Luther King Day. It's a special because normally you'd have to pay for the options letter and the room. This is a good deal, and it's a good time of the year because of earnings season. Someone's asking me, which broker? No, I'm saying you can't trade options before the pre-market. That's exactly what I said. You cannot. You cannot. So I'm doing the work to decide what I want. I call the trades in the pre-market. Everybody's ready to go and set up to take them into the open. Now you can do the QQQs and the SPY as options. Actually, I think it's 10 minutes before the open and 10 minutes after the open. But no, I said you cannot take options trades in the pre-market. I'm saying I'm not doing any trades in the pre-market, equity or otherwise. And actually, I don't get in the options in the Qs or the SPY in the pre-market, but you can actually enter those, I think, 10 minutes before the open and 10 minutes after the close. Is that clear? Any questions from anyone at all? And if you're interested in sitting in a trial to the room, email me today. I'll send it to you for tomorrow morning. We'll see what we get. We'll be watching Tesla. We'll be watching the market. I'll look at it right now. info@drstoxx.com or melissa@drstoxx.com. Any questions, anyone? Thank you so much.
All right. Well, very good. Thank you so much for inviting me. And it's great to be here. I love the presentations here. Always, it's just always a great experience. You always do a great job of organizing and getting people here and getting fantastic presenters. So I'm really honored to be part of that. And To everybody who's here, everybody who's attending, welcome to my presentation. I've got some really good stuff for you. And I did mess up though. I will have to come clean on one mistake that I made. And I'm really sorry for this. I know a lot of you are going to feel horrible and be mad at me, but I dropped the ball and I did not come with anything to sell. So I apologize for that. I have nothing to sell at the end of this presentation. I do have some freebies I can give you if you'd like, but yep, nothing to sell today. So I apologize heavily for that. And please, 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 in the name of all that is holy, forgive me. Otherwise, I won't be able to sleep tonight. So, but yes, I do have some freebies for you. In fact, I'll tell you what, if you stay till the end, and I should be done in about 45 minutes, I'll actually give you for free one of my little mini courses. And this has, I mean, it's very practical because it has one of my favorite trade setups in it called the rubber band trade, which is a complete trade setup strategy with rules, entries, exits, all that good stuff. So yeah, because what I want you to do is leave here, be able to go and have a trade that you can actually, you know, start making some money with. Of course, I do recommend that you start with a simulator or demo account first. Make sure you can make it work for you. And once you start making money that way, then, well, if you want to, put some real money in it. And yeah, let's ring the cash register. Okay, so today I haven't given this little presentation for quite a while, so brought this back and updated it a little bit. So as you can see, how to time your trades to make big, or for when the market makes big moves, but avoid getting stopped out. So these trades, the hallmark of them is they really have a great risk reward ratio. And some unique stuff here that is very kind of professional grade. So Anna, she gave me a nice little presentation there, but there's my ugly mug. I am Barry Burns, owner and founder of TopDogTrading.com, author of Trend Trading for Dummies. I've received numerous Reader's Choice Awards from Stocks and Commodities magazine for best paid trading courses, helped other people with their books, and worked with a lot of major companies out there. I'll just flip through this here real quick. I know you didn't come to hear about me, but important you know who's talking to you. And if you want to read my full bio, feel free anytime to go to topdogtrading.com, click on the About Me tab, and see my full bio there. Oh, also check out my podcast. I have some great content there. Absolutely free, obviously, for podcasts. And I do some topics myself that I cover and give you great free tutorials. And then I also do some interviews with really prominent traders, and did an interview of a trading psychologist recently. And that is the best results that we've gotten on any podcast. So check out the one on Dr. Howell. Really powerful about trading psychology. Oh, I guess the people listening like us because they pushed us up to number 10. That's on iTunes in the investment category, even ahead of the Mr. Jim Cramer from Mad Money. So Jim Cramer, love you, brother, but can eat my dust. I don't know if I'm still there. I think that was like a temporary thing. We got ahead of him for some reason, but yeah, Jim's awesome. But yeah, we snuck ahead of him there for like a week. All right, so our legal disclaimers, I'm not going to spend much time on this. I know you guys have heard these things a lot of times before. Just understand these things are very important, and they're not just legalese, they're actually for your education. The regulators have gone out there and did the research as to why most people lose money trading. And that is the truth, most people do. So read the legal disclaimers because that is intentionally designed to help you not lose money. It's not just legalese, it's actually very practical stuff. Okay, so now today what we're going to be talking about is volatility. When we talk about making money on big moves, we're talking about the energy of volatility. Volatility is exactly the price range of the market in a given period of time. So this is just our little quick view, so we're all on the same page, have the same concept of what volatility is. So from here to here, we have a high volatility period of time. Covers a wide range of price in a short period of time. And therefore, one of the best geometric ways to illustrate that is with a rectangle. So you see we have a high rectangle with over a little period of time. So this rectangle over here, this outlines a low volatility period of time. So not a very wide range of price over a larger period of time. Okay, so that's just the general concept, just so that we're all kind of on board with the the big picture of what it is. Now, what are some patterns that we can trade based on low volatility going into high volatility? And that's what we're doing. We're looking for low volatility markets, catch them at the end as they're about to go into a high volatility cycle, big moves. Well, some of the most common patterns are Bollinger Band squeezes, awesome. Contracting channels, those can be very good. Wedges, triangles, which are kind of a brother or sister to wedges. Moving average convergences, and I think we'll talk about that a little bit here today. Moving average convergences, okay, triangles, detachment from equilibrium. These are the three we're going to talk about today. Okay, we're not going to talk about the others. Each one of these could be a whole presentation unto itself. So today we're going to focus on these three. All right, get your pens ready, get your mind active, drink an extra, I don't know, mocha latte or something, get those brain cells firing, and let's go. So pattern numero uno is moving average convergences. Very simple concept. I use these for moving averages. By the way, if you use others, that can be okay too. But the important part that is not negotiable here is that you do have to have at least one short-term moving average and one really long-term moving average. That is at the core. So these are the ones that I personally use: 15 EMA, 50 SMA, 100 SMA, and the 200 SMA. So here they are on mine. So on mine, we'll go over here to show you. The black line is the 15 EMA. My line here that turns from green to red, that's the 50-period simple moving average. My golden line is the 100-period simple moving average. And this kind of purple plum, my wife would know the exact right name for that color. I just call it purple. She'd be like, no, that's not purple, that's plum. I'm like, okay. So anyway, we'll call it plum to be a little more sophisticated today. So that's the 200 people or simple moving average. Now here's the key. The key is that they are all contracting or binding together at some spot. So what does that literally represent? What does that literally mean? What that literally means mathematically is that over the last 15 bars, 50 bars, 200 bars, and 100 bars, I skipped that, there's been no change in price. Right? Very little. Yeah, you could say, oh, there's a few pennies here and there. Okay, but in the big picture of things, very, 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 very little change in price after the accumulation of 15 bars, 50, 100, and 200. So everything over the last 200 bars, and by the way, when I say bars, being very specific there, because as you can see, this is a 3-minute chart, but this would work whether you're using a daily chart, 60-minute chart, doesn't matter. We're talking about the number of bars. So this is time frame agnostic, if you will. You can use this pattern. In fact, all these three patterns that I'm sharing with you, well, now the first two specifically can be used on any time interval. The third one is more for day trading. Okay, so this is one type of situation where we see that the market has been in a relatively long-term low volatility cycle. Now, I say long-term because you see here, we did have a big move down, okay, a relatively big move down. That came right back in to the moving averages. So there will be aberrations like this, but because we got the 200 SMA as the outlier, then it kind of dismisses this because again, it's saying the average of 200 bars, very literal, very mathematical. So when we see this tier together, that's when we see, okay, we've got our convergence of those four moving averages. And there are various cycles in the market. but one of them is expansion and contraction. Expansion, contraction, low volatility into high volatility. And that's really the trade here. And our last speaker was speaking about options quite a bit, and I love to trade options. And this actually would be a great setup if you're trading option volatility strategies. So you would get in here where there'd be a low volatility, and if your option strategy is to look for increased volatility, even if it's non-directional, this is a pretty darn good little pattern here for you to look at. But obviously you don't have to be trading options with it. You could be trading stocks, futures, forex, commodities, whatever you want. Right now we've got Apple up here, but again, it's you know, it doesn't depend on volume, so it'd be great for forex as well. So as the market moves forward, as the market moves forward, as my slide moves forward, there we go. You see that we get our big move. So back here is our consolidation, convergence of the moving averages. Gets above the moving averages. Now, this is a little longer term play than some others. And that's because you get the 200 simple moving average involved in there. So this is a long term. Again, there will be false breakouts above and below. And that's important to understand. So we get a move up, boom, okay, boom, but then it comes all the way back down, and that's when the rocket is turned on, and NASA, boom, we are ready for takeoff. So it comes outside. This is where we get a little bit of a trend going. We do. Comes back in, but now look, we've got what's called a moving average stack. 15, 50, 100, 200, and nice, great candlestick pattern there. And now the market says, yeah, finally, you know, enough of this stuff. We're aboard. Okay, time to go to the moon, Alice. And that's what it does. Right, so that's one that I don't see taught a lot anymore. This is not something I invented, but I don't know who invented it. I don't know if anybody knows, but it is a very powerful, explosive pattern, and you can make some big moves real fast. Now, this one's one of my favorites. So this is pattern numero dos, and this pattern is triangle. However, I trade triangles differently than most people. Again, I rarely, in fact, I never learned this from anybody. I made this one up myself. Of course, whenever I say that, then somebody says, oh, Billy Bob does that. And okay, well, nothing new under the sun. But anyway, so triangle patterns are great. I love them, love them, love them. Back in the day when I worked for another company and they hired me to do their moderating for about 3.5 years of the markets every day, I used to be known as the Triangle King. I was showing triangles left and right, and helping people work through these triangle patterns. And I love these. So let me show you how I trade them though. There are a couple of different types of triangle entries. And there's actually, we'll bring it down to 3 just to make things simple. So first of all, I'm talking about a symmetrical triangle here, meaning we have a lower high and a higher low. However, there are obviously other types of triangles. There's ascending triangles and descending triangles. And then there's wedges, which are not technically triangles, but very similar and can be traded in a similar way. So we're going to look at a symmetrical triangle here, which means lower high and higher low. And here's the apex. So traditional ways of trading triangles. One of them is just to trade the breakout of the trend line. Wait for that puppy to break out and basically just go short there. Okay, I never do that. Don't like it, not my cup of tea or my cup of mocha latte. So if you want to do that, God bless you and the horse you rode in on. Not saying it's wrong. It's one valid style. I just find that breakouts these days are kind of trickier than they used to be in the days of yore. And so many false breakouts, so much noise after breakouts. I just, you know, I don't want to deal with that. I don't have the patience to do that. So I like things that are nice and clean and simple. So the other type, because of this problem, traders came along with the second strategy in order to trade breakouts. And they'd say, okay, I'm not going to trade the initial breakout because we do get noise or false breakouts. So we're going to wait for the retrace. We're going to look for it to come down and then retrace back close to this trend line, may not get to exactly, and then go short from there. So as you can see here, we hit the 50-period simple moving average. That provided support after the breakout. Retrace, oh, but that still wasn't enough. And then it went up and made a little higher high. And this is, one of the problems that comes. You still get noise sometimes. So this is my worst favorite pattern. Can you say worst favorite? I don't know. Least favorite, that's it. Least favorite. Most favorite. You learn a lot of unique English terms if you hang around me long enough, and they're very unimpressive. But anyway, turns into a megaphone or an expanding triangle. The more classic term is expanding triangle, but some people call them megaphones. Either way, these things are the bane of traders' existences, because again, if you wait for the breakout here, or if you wait for the retrace here, then it comes out and makes a higher high. So lower low, higher high. That is a high volatility, non-directional pattern in the short term there. And that's what megaphones are. They're high volatility, non-directional, because you get a higher high and a lower low. So volatility and trend are uncorrelated energies for that reason, because trend is directional by definition. Volatility may be directional, may not. It just has to do with the range of price action. So again, I've traded these. I've been trading for 50 years, by the way. My dad was a stock trader, so I was raised in a trading family. And he started teaching me when I was 8 years old at our dining room table in Detroit, Michigan. So been around this stuff forever, and I've seen all the changes in markets over the years. And so I've had to evolve with it. So we used to do this kind of stuff, and then, the more time went on, the more people got involved in trading, electronic trading, algos, high frequency trading, day trading, direct access. It's like things changed. Patterns that worked in the past don't work in the future anymore. So I don't like either one of those entries personally. If you trade them and you're making money, great. Hey, if it's not broke, don't fix it. So here's what I do now that I've evolved with the markets. I trade what I call inside the triangle. And I do consider this a more professional approach to the trading. One of the distinctions between professionals and amateurs is, as professionals, we're always in earlier than amateurs. Amateurs are in late, professionals are in early. It's kind of analogous to the slogan, buy the rumor, sell the news, but with regard to technical analysis. So I don't wait for the breakout. I don't wait for the breakout. That's when all the retailers are getting in. That's when everybody sees it. Everybody's, not everybody, but a lot of people will see this as a triangle. And if it's an obvious pattern, then a lot of retail traders will trade the breakout. And that's because that's when everybody and their parakeet sees it. Well, when everybody and their parakeet sees anything and they're trading it, then you'd be trading with the herd. We're with the masses, and the masses lose money, as we referred to earlier. So you got to buy the rumor of the breakout. The rumor of the breakout is here. And what if it doesn't break out? Well, fine. I just lock in some profits here, maybe make a couple bucks, and then do it again the next time. But I'm willing to do that, and I'm not going to wait for the market to come back all the way up here. If it breaks out to this side, I'm not going to wait to get stopped out up here. That'd be ridiculous. That'd be cray-cray, as the youngins say these days. So no. What we do here is, and by the way, this is not all that I have on my charts. So yeah, I am definitely using other tools here to determine exactly where that high is going to be. I have a cycle indicator that I use to tell me, is that the right time to make that high? And what the heck, I'll give you guys my cycle indicator too, so you can have that as well. I'll show you how to get that at the end too. Absolutely free, even though I do sell it. You guys are here, and I love this event, and so I will go ahead and give that to you for free as well. So investor expos, people get extra goodies. All right, so using my cycle indicator, I identify that that is the final cycle high. It's a lower high. We've already had our higher low. So I'm saying, cool, I'm going to trade that before everybody else gets in. And that's why I'm trading inside the triangle, going short, and then just hang on. And then look what happens. Then we get, again, contraction. So contraction, getting more narrow, low volatility, right? Higher, high, low, higher, lower, high. Decreased volatility here. So contraction, and then boom, expansion. And then now we're back into contraction again. So that's what we're talking about with volatility going in cycles. All right, love this trade, by the way, one of my very favorites. It's, you know, now test it out because everybody has a little different brain cell combination. And so sum up trading, you just have to test out. Even if a trade setup works for someone else, does not mean that it's going to fit your personality or your comfort level, or that it will resonate with you. When I was working for that company, doing the open and the close every day in the live trading room, there were a lot of people there who, even though I showed them triangles time after time after time, 4 or 5 times every single day, they never really got it. And I would even do quizzes with them. I'd say, look, there's a triangle. Somebody show me where that triangle is. I'm not going to show you. You show me. Because I wanted them to, you know, be self-empowered. I wanted them to be able to identify it, not just depend on me all the time. Because I only worked there for 3.5 years. So when I was gone, they had to do it. They should have been able to do it by themselves. Some people never could. It just didn't resonate with them. Others, oh, they also became triangle masters. And they're like, Barry, that's all I trade. Because those things are so cool. They're so reliable. Win-loss ratio is just completely off the charts, literally. And so, you know, some got it, some didn't. And this is where just because something, you know, you can't make it work or it doesn't seem to work for you, doesn't mean it's unreliable. It just means that, okay, cool. Go find a different method or a different pattern that you like, that resonates with you. And that's perfectly fine. Nothing to be ashamed about that. So that's why I show different patterns. Don't expect you to trade them all. I want you to find the 1 or 2 or 3 that become your favorites, your go-tos. Now, here's another little insight into this. So this is, again, getting into a little bit of a advanced concept, but it's it will make your win-loss ratio higher on these triangle breakouts. So as you can see, this is a head and shoulders. So we have, yes, I do wave counting as well. So there's wave 2. We're in a trend. We're in a trend. Wave 2 in the trend, wave 3 in the trend, wave 4 in the trend, a failed wave 5. Now, the average trend in the market is 5 waves. So we are now at the average length in a trend. This gives us a statistical probability in this trade. In addition to the triangle, remember I said I put other things together with this, so giving you an example of that right now, that we have reached the end of the trend. Remember the old slogan, the trend is your friend until the end. And that's true, and that's great, but it's too vague. How do we measure that? How do we know when the trend is no longer a friend? The way we know from at least a probability point of view is that the average trend lasts 5 waves. So once we get to wave 5, then the trend is no longer our friend. So now we're looking to trade counter trend. The counter trend is our friend. So now we've got what I call in Top Dog Trading concurrent setups. Concurrent setups means you have 2 reasons to take the same trade. So the 2 reasons here are, number 1, we're in an extended trend. We've reached our wave 5. So now we're looking to take a counter trend. And we've got a triangle trend, a symmetrical triangle. And that's why I would rather go short than go long, because the trend's no longer my friend. So I'm not looking to take the longs, I'm looking to go shorts. Okay. So if you take this puppy, then that's beautiful. So as it says here, head and shoulders, we've got our arrows there so you can see there's a high, there's a higher high, and there's a lower high. shoulder. Let's see, I'll put some letters there. You can see how my calligraphy has improved dramatically since I was in kindergarten. And there's your two shoulders and there's your head. So we got head and shoulders. Again, put all the pieces of evidence together. That's what we do at Top Dog Trading. We understand there are no certainties in trading. All we can do is trade probabilities. Those probabilities are based on statistics, mathematical statistics. The more pieces of evidence we get, the higher the probability the trade. So our pieces of evidence here are extended trend. Trend's no longer a friend, therefore the probability is short. Number two, head and shoulders pattern. That's a topping pattern. That's piece of evidence number two. Piece of evidence number three, symmetrical triangle. So I put all three of those pieces of evidence together and I say, God darn it, yeah, that's a good trade to go short. High probability. Make sense? By the way, before we move on, since we're live here, heck, let's take advantage of that. Why am I doing a monologue? Any questions on this? This would be a great time for me to ask or for you to ask any questions. I will also accept not only questions, I will also accept preguntas, and I'll also accept fragens. So this is for international audience. Good question there from Fridar. Hopefully I pronounced your name correctly. If I didn't, I apologize, but doing my best here. It's a good question. Where is the exit? Okay, so exits are a little trickier than entries, admittedly, and every trader that I know has said that. I've talked to a lot of retired traders, professionals who've traded all their lives, made millions of dollars, and as I've interviewed them and talked to them, I said, hey, how did you determine your exits? And every one of them to a T said, yeah, I can't say that I ever mastered exits, but I made a lot of money. So we have mastered entries. Entries, very clear, very precise. Exits are what's the term I want to use here? They're harder to just nail to the penny paper tick. Entries, I can nail to the penny paper tick. Not that I don't ever get stopped out, but it's really precise. Exits, you just kind of got to watch them bar by bar. So what I do, in other words, when I enter, I don't really have a predetermined exit. This is the best way to explain it. When I enter, so let me get rid of all this gobbledygook so I can put some new, and that's a great question, by the way. Put some new annotations on here. So when I go short here, here's what I'm thinking. I'm thinking, okay, my first target is going to be either here or here. In other words, I'm looking to get out at the first level of support. Now, that's just partial exit, not with my whole position, but my partial exit. Because we could stay in the triangle here, or we could go down and break out, and then our next support level, this is our first support level, that's our second. The way I'm going to determine which one I exit at is with momentum. So with momentum, that's strength. That's the strength of the market. So support resistance levels are, again, one piece of evidence, but we need more because, as you know, support resistance levels are broken all the time, right? Sometimes they are, sometimes they aren't. What makes the difference between whether a support or resistance level is broken or whether it isn't broken? And the answer to that is how much money flow is going through at that time. What's the strength of the money flow? If you reach a support level, but there's still a lot of big selling at that level, it's going to break through that support level. If a lot of selling comes out of the market, people start taking profits there or even buying off of it, then it's not going to break off that support level. It's going to at least make a temporary bounce. And so that's what I'm doing. I'm watching in real time, bar by bar. Okay, that's my first theoretical target. That's the word I was looking for earlier. Theoretical target. And then when we reach there, I look at the money flow, the momentum, and I say, okay, do we still have bearish strength? If we still have bearish strength, I'm not going to get out just because there's support. When I see that money flow shift and the momentum shifts at a support level, then I'll take my partial exit. Okay, then I use trailing stops. And then I use, yes, as Music Mania said, money management. Absolutely. Money management, 100%. Really glad you said that, by the way, because very few people ever refer to risk management or money management. So congratulations to you, because that's actually more important than technical analysis. So thrilled to see that comment. Okay, so, but then we have our trailing stops and money management, certainly. And we look for, by the way, another thing I look for is when the energies of the market, the money flow of the market totally reverses, then I'll use that as a trailing stop as well. And sometimes I'll stop and reverse, just depends how strong that is. Okay, so yeah, that is, that's basically how we do it. So that could be a whole course unto itself, and we have, 10 minutes. So, oh, Sridhar, yeah, you're already a student of mine. So send me an email about that, and I'll be very happy to give you a little more details. It's actually in the courses. Tell me which courses you got, and then I'll try to find in the courses, where that is, so that you can get a more detailed answer. There's my email address for you. Okay, so for the sake of time, to make sure that we don't go too far over time, we've got to now continue going. So next slide. So the next slide is the third setup. And pattern 3 is detachment from equilibrium. So now this is the one that is more focused on day trading. Can be day trading for stocks, forex, futures, commodities, whatever, but you can do this with swing trading as well, but it's really it's easier to do with day trading. So I'm going to give you a day trading example. So when I talk about equilibrium, what am I talking about? There's two things that can be used for equilibrium. The easiest one, most obvious one, would just be yesterday's close. So this line here, this is the beginning of a new day. This gray line here, that represents the close, the difference between the close from yesterday and the open from today. So yesterday's close happened right there at the low of the real body of that bar. So that is where, after all was said and done yesterday, the market participants decided that's the value of the market that day. After all the news came out, the rumors, the tweets, whatever, the market says, okay, that's what we're valuing the market today. Market closes, okay, opens the next day. Now it's going to have a new value, potentially, because a lot of stuff happened overnight in Europe, in Asia, even in the US, whatever. So now when it opens up here. And that's because of whatever happened overnight, changed the sentiment of the market. But this yesterday's close, YC, yesterday's close, is our point of equilibrium, saying, basically, think of a daily chart. So that's where the close is on the daily chart. And anything above that would be bearish relative to yesterday. Anything below that will be bearish relative to yesterday. So we trade that now intraday. The other point of equilibrium is you can put floor trader pivots on here. So floor trader pivots, I put them on my charts, and PP stands for pivot point. That's your central pivot. And then you get your R1 above, you get your S2 below, S1 and S2 below, and so forth. That S stands for support, R stands for resistance. But this is your equilibrium point based on a different formula, and that is the pivot point formula, which you can check it out on Google it, and you can see the formula. It's very simple. But the central pivot or the pivot point, those are synonymous terms, by the way, that's going to be your point of equilibrium, meaning anything above it is bullish, anything below it is bearish. Now, I put both. You can use one or the other. I like to use both on my charts, and that's because the markets are a little noisy, and there's a little bit of randomness, a little bit of chaos, a little bit of noise in the market. So what I do is I put both of them on there, and then I get a drawing tool. Usually your charting platform will have some sort of drawing tool. We can draw an equal or a rectangle on there. I highlight it yellow, being transparent, and that's the zone. So that's the equilibrium zone. Now, that is kind of the balancing point, if you will. So I now consider anything above that zone bullish, anything below it bearish. All right, now what we're looking for is detachment from equilibrium. So the equilibrium is our balancing point, and we're going to look for it to go into that balancing point and then break out one direction or the other. So a couple of interesting points here. So number one is that, remember I talked about breakouts being false a lot these days, false breakouts being the bane of existence for a lot of traders now. So in this day, we gapped up, and then the market decided whatever news, rumors, gossip, who cares? And it comes back right into the equilibrium point. So it dismissed all of that. Okay, dismissed it all, devalued it. And then we get our breakout. So here again, kind of like with triangles, you get a breakout. Some people, we breakout traders and they'll break this out up, but then what happens? Market retraces. So now you get again your opportunity to a breakout trade, but on the first retrace after the breakout. It follows through a little bit, but what happens? Comes right back into the equilibrium point. Okay, that's what I like to trade. That's what I like to wait for it to come back, because I assume most breakouts are going to be false. Now, what happens if it's not a false breakout? Because some breakouts do follow through. In fact, the advantage and disadvantages of each of these three entries is if you trade the breakout on the breakout, then you're going to have a nice big winner. If it is a false breakout, then you're going to lose. The advantage of, so disadvantages and advantages of each. The advantage of taking the first retrace is if this is a false breakout, but this holds below, then you've got a more conservative trade, But the disadvantage is you don't always get a retrace. Sometimes the breakout just goes like this, and then you won't get a trade. So as a trader, you just have to decide and live with the fact that, okay, I'm going to take one of these techniques. This is going to be mine. And the rest, I just let other people make money with that one. And that's cool. And you cannot have what's called trader's remorse. You will mess yourself up psychologically if you have trader's remorse. Trader's remorse means basically something happened, you didn't take it, and you're sorry you didn't. The only reason you should be sorry you didn't is if it's part of your trading plan. You need to set up a trading plan, a strategy, a system with rules. And the only time that you're quote unquote wrong, as long as your plan is statistically sound, is if you don't keep your rules. Because nobody catches every move in the market. That's impossible. Nobody does. So we all pick our little piece of the pie here, of what our game is going to be inside of the market, and we just trade that. Like I said, you find the one that matches your personality type, that resonates with your brain. And then you're just like, okay, this is my game. When other stuff happens, great. Other traders can make money with that. That's their game. I'm just taking this little niche, and I'm going to trade it consistently as heck. But I'm going to be a majorly, perfectly, impeccably consistent trader of my method. And I understand what I'm giving up, and I understand what I'm gaining. But this is what I'm comfortable with. So, and by the way, here's another little insider tip. Yesterday's low, that's what YL stands for. Used to be, back in the days of yore, that people would say, oh, once you get below yesterday's low, we are in a real bearish market. Or once we get above yesterday's high up here, we're in a really bullish market. Again, everybody in their parakeet knows that now, and so it just doesn't work as well. I can't tell you how many times I see the market break below the low or below the high of the previous day and then come right back into it. So again, it's one of those things, once everybody knows it, doesn't work anymore. So I wait for it to come back in here and then go out. Now look, yesterday's low, people are a little hesitant there, right? That's called uncertainty. And look at how well these pivot points work. Look, by the way, I've got mid pivot points on here too. Goes back to S1, goes down to S2. These floor trader pivot points work really good. Highly recommend that you at least give them a try. Most charting platforms have them in native into their indications and their indicators. And then by the time the day is done, this is to the end of the day, California time, And you can see, again, all these trades are about low risk, high reward, big market moves. And the contraction, which is here, we're in a contracting zone, and then the expansion cycle. And that's the whole point. Very little risk, very big reward. Where's it go? It goes to the mid pivot point at the end of the day, between 50% between S2 and S3. That's what that represents. And by the way, that's another little tip. I'm giving you guys a lot of cool tips here today, seriously. A lot of people don't use mid pivots, and they should. They should, especially on when the previous day is a wide range day. I always use mid pivots. If the previous day was not a real wide range day, then they're not as consequential. But if the previous day was very wide range, then yeah, I always use them. Okay, so let's finish up here. Important factors. I gave you 3 trade patterns today. Which direction to trade is one of the questions that comes up. I gave you some ideas about that already. How extended are you in the trend would be one. Another one would be trading in the direction of momentum of the higher time frame. You never, ever, ever want to trade against the strength of the market on the higher time frame. That is that holds veto power over every trade. Why would you trade against the strength of the money flow on a higher time frame? And then also, you don't want to be in too early or too late. So timing becomes really critical. And that's where my market timing indicator comes in. So, which I'll give you for free. So here's my final slide, and here's my final strategy, and I nailed it to the minute, surprisingly. So as I promised, I'm going to give you my rubber band trade strategy for free in a little mini course I've got, 5 videos. And these 5 videos will give you a bunch of stuff. You know, I referred several times today about the distinctions between professional and amateur traders. And that's really what this mini course is about. It's really about the difference on certain trade patterns between amateur and professional traders. So you're going to get that. The rubber band trade is included in that. You get little quizzes in there too, which will give you little feedback loops to make sure you're getting it right. And then, as I said, I'll give you my free cycle indicator. That takes another webinar. A lot of this stuff, you know, I'm giving you as much as I can here in 45 minutes. The cycle indicator, that's going to take another webinar. That's about an hour. So we'll get that set up on your charts. It works on any charting platform, by the way, because actually what we're doing is we're just taking a indicator that's already on your charts, very, very common indicator, but modifying it. So that's the cool thing. It's not like, oh, here's a little program, but it only works on software that has this type of programming language. No, we take a common indicator that's already on every charting platform out there. We modify it, and I walk you through on the webinar exactly how to modify it step by step. So you get that. You'll have it done on your charts. And then I go and I show you exactly how to trade it, the patterns we use to trade it. And I even get into the penny, the pip to the tick of where we enter, and the penny, the pip, and the tick for your protective stop. So very detailed, that's more of a deep dive into one topic. So if you're interested, totally free. My gift to you, just go to topdogtrading.com/free, and that's where you get it all. So that's, oh yeah, so a couple questions here I can answer real quick. So Sridhar, why do we draw yesterday's low and high there if they are no more useful? They're useful in the sense that sometimes they still do work, but you want to see what everyone else is seeing. The bottom line answer to that, great question by the way, is that we want to see what everyone else is looking at. So because those are levels that other people will respond to. Right? If they see those, they're going to respond to and either buy or sell or take profits into them, or at least they're levels that, you know, people are making decisions around, the masses. So that's why we definitely want to see that. And then we use the bar by bar money flow in order to determine what's going to happen around those levels. The next question is, why do people still use minute charts? Tick charts seem to be the best. Yeah, I use tick charts too. You know, they both, again, like most things, have advantages and disadvantages. I love tick charts. They take a lot of noise out of the market. That's one of the big advantages of them. Also, my risk on my trades tend to be less when I use tick charts. Minute charts, one of the advantages is if you like candlestick patterns, your candlestick patterns are going to be more like the traditional candlestick patterns on time-based bars. The other benefit of minute bars is that if you use a little timer that counts down how much time you have left in each bar, especially for day traders, then that's going to be a little more easy to read because it has its natural rhythm, which is just time. How many seconds are going by before that bar closes, so that you're ready psychologically and you know, okay, I got 5 seconds till the next bar is going to form. Whereas with tick charts, you don't know that because it's based on the number of trades instead of time. And trades can all of a sudden, like it could be going by kind of slow, you know, a few trades go by, a few trades go by, then all of a sudden, you know, 100 trades come in like 1 second. So, and that throws off your rhythm for entering. So advantages, disadvantages of both. In general, when I day trade, I usually use tick charts, but I do always have a 5-minute chart up as well. And so, yeah, anyway, that's as much as I can go into that, but yeah, hopefully that helped. All right, well, that is it for myself. Anna, thank you very much for inviting me. Always a pleasure to work with you, and it's just great to work with investor expos all the time. I've done so many of these, and it's just gets better every single time. You guys do a great job over there, so thank you for including me.